There's a pressure in Europe, recession odds growing there after weaker than expected PMI data. Euro area PMI is contracting for a seventh straight month, coming in below estimates for December. Separate PMI data for France and Germany also showing the downturn worsened in the area's two biggest economies. Traders adding to bets on ECB rate cuts for next year after the bank held rates steady yesterday. Two things here. First, the actual economy, and second, the fact that nobody believes Christine Lagarde and her hawkish tone yesterday. I want to start with the economy, Damien. How much can you really see that recession developing in a more significant way, especially in light of a lack of a bone kind of thrown to markets from Lagarde?
Very much so, and a lot of it coming from China, right? I mean, so, let's be clear, I do believe that the consensus is that Europe will indeed go into a recession, whether it's shallow or extreme remains to be seen. But just look at the price action off the back of the PMI data overnight. Euro dollar sold off after almost touching 110, literally touching 110. And now you've got bunds rallying pretty aggressively. So now it's kind of, a little bit more of what we've seen here in the U.S. over the better part of the last week. And, yeah, I think there's room for rates to come down here in Europe.
Which is the reason why I think a lot of people are definitely for the U.S., regardless of the underpricing that they're seeing elsewhere.
Exactly. You think about all the haven aspects that's in the dollar that are in the Treasury market, and it's pretty hard to deny.
Meanwhile, talking about China, Treasury Secretary Janet Yellen planning yet another trip to China for next year. Speaking at a U.S.-China Business Council meeting last night, Yellen says she expects to focus on, quote, difficult areas of concern with my counterpart, and restated national security as the top priority.
We will seek to cooperate with China on global challenges. And because our national security must remain our foremost priority, we will deploy our economic tools when needed to secure our country's national security interests and protect human rights.
One of the biggest wild cards for next year is really going to be China and the U.S. relationship. Therein, Katie, there's been accusation that U.S. companies have been dictating foreign policy more than the government. Are we getting a sense that the government is kind of moving toward companies, or the other way around?
It's a great question, and it's one of the big issues that Janet Yellen is trying to dance around. It's interesting to watch her emerge as one of the key architects in bringing these two countries back together, really establishing this relationship, even though there are some huge issues that remain, especially when it comes to the semiconductor industry.
Yeah, well, look, Moody's put a negative outlook on China just a few weeks back, but I think, what we've seen overnight, we saw some data come in, we saw fixed asset investment come in a little bit better than expected. China's going to be pumping in over $100 billion into year-end just to kind of keep the pipes moving, keep liquidity there in the near term. But I think what's really interesting is the fix last night was as strong as we've seen in some time. That means China's, a proponent of seeing the yuan go higher from here, appreciate relative to the dollar. That can be a good thing for growth in the economy.
Which raises this question, how much are they actually going to do, right? Yeah. And this is really the ultimate question for next year that people say, not just with respect to China, but also with respect to the global economy and European markets in particular. Bill Lee knows about this very well, and we're so pleased to get him to weigh in on this. He's chief economist at the Milken Institute with years of experience watching Chinese markets and understanding the psychology behind them. Bill, what do you make of that? Do you think that the what we've seen so far with respect to stimulus is just the tip of the iceberg from the PBOC?
Oh, China is suffering from the 4 Ds, right? Lack of demand, the de-risking that the U.S. and China are involved in, bad demographics, and heavy debt. So they really have a lot of headwinds to deal with. And right now, the management of the economy, the Central Economic Work Conference that just took place, they're pulling out the old solutions, which is we're going to bolster the supply side. We're going to try to make our industries modern. We try to shift our resources to try to bolster the supply side of the manufacturing sector. That is not the solution that they need to support the economy, because the real problem, at least in the short run, is deficient demand. There's no one willing to consume. And I think the fiscal policy on the part of the Chinese is one where they just have an aversion toward putting support into the household and into the private sector. And instead, they want to shift emphasis onto the public sector. And that's one of China's key problems.
Bill, as U.S. election season ramps up, many are expecting China-U.S. trade rhetoric to kind of pick up again. Obviously it's one of those few topics that both parties agree upon. Do you see this as a risk? Do you see, markets beginning to price in an increase in U.S. tariffs on China in the coming year?
I think one of the things that is going to come out of the election campaign is that everyone will agree that we need to de-risk from China. And I think one of the results we already see is a diversion of capital flows away from China to the rest of Asia. And unfortunately, the Chinese don't seem to recognize the seriousness of this, because President Xi has not addressed anything past the speech he gave in San Francisco about how China is open and welcomes foreign investors, but they've done nothing to reduce the Espionage Act and all of the measures they put in place to make it difficult for foreign investors to get into China. So this heated debate that's going to be amplified by the election is going to make the tensions even worse, and that's why Secretary Yellen is really going ahead of the wave of and then trying to get a charm offensive going on both sides, both from the Chinese and also from our side.
Bill, when the China-U.S. trade war first started, there was a lot of talk from multinationals about how they can't afford to pull out of China, the insatiable demand that was coming out of China. Yet fast forward a few years, and here we are, and the cost of doing business in China has gone up considerably. What are multinationals saying? Do they want to continue to do business in China?
Well, actually, it's split. The people who are already in China are the ones that are applauding President Xi's speech, and they're saying we are devoted to China. We're going to be staying in China because China is our market. But if you ask the real question, where are you putting your marginal dollar? More often than not, you're going to hear, I need to diversify my supply chains. I need to de-risk. I need to find places that are cheaper for my manufacturing, and that's often ASEAN and other parts of Asia. So the policies that China has put in place have really not done themselves well in terms of keeping investors there and attracting more money.
Well, let's talk about investors there. You know, you mentioned the multinational perspective, but when you think about confidence on the part of investors, is it there, and how do you restore it?
China was thought of as the great market where all I have to do is sell one item of my all I do is sell one Coke and I'm going to make a fortune because there's so many people there. I think one of the things that people are realizing is that while there's a huge population, it's a population that currently is not willing to spend because they don't have the confidence in their income being secure, and they don't have the wealth being secure because of the property market. And right now, without a public safety net as one of the supports that China can offer their people are just saving a lot of their money. And I think the American investors and Western investors are realizing that it's not a safe market, at least in the near term, until China is able to put in some safety nets that will assure the Chinese consumer that their income is secure and their wealth is secure.
Did Fed Chair Powell kind of give a lifeline to both China and the rest of the world, given the fact that there is a massive shift in tone this week?
Oh, absolutely. And you know, when I was at the Fed, one of the things that we worried about was whether the transmission of monetary policy was effective or not. And we looked at the real interest rate. And right now, if you look at the belly of the curve, which you're fond of mentioning, the most liquid part of the curve, you see that the real rates there, adjusted for inflation, is somewhere over 2%. That meant that we were drawing in quite a lot of capital from the rest of the world. But Chair Powell, by saying that we're going to be targeting that real rate and reducing it, lowering the Fed funds rate, I hope by the same pace as inflation's going down and maybe a little bit faster, that will reduce the real rate differential between us and the rest of the world, and that will stem some of the outflow that's coming out of China.
Right now, we've seen some of the biggest two-day declines in real rates that we've seen going back to the height of the pandemic. Right now, 5-year real rates, 1.69%, down from a high in early October of 2.6%. I mean, just really shocking moves. Bill, do you think that this is overdone, though, given the fact that we're getting stronger than expected data and that yesterday's retail sales came in stronger? I mean, is it consistent to you to see a strong economy and ongoing disinflation, regardless of the fact that we have a fully employed America?
We've always counted on markets overreacting, and this is another example of markets overreacting. And Chair Powell put the rate cuts on the table because he wanted the markets to start to lower these long-term real interest rates. And it gives him time to slowly adjust the Fed funds rate, probably wait until spring or summer before actually starting the implementation of the stuff, of the rate cuts. And that way, I think he can smoothly navigate that real rate down. Now, if something goes wrong, he has the option to be able to raise rates to offset any kind of upward blip in inflation or go down even further if the economy actually were to go south.
Billy of the Milken Institute, thank you so much for being with us. I've got to say, the volatility that we've seen over the past week, over the past year, has been shocking. And you do wonder, Katie, what the consequence is of these sort of whipsaw moves in full faith and credit, the sort of benchmark rate for all other instruments.
I know, it has been just fascinating to watch really the epicenter of volatility become the bond market. The ballast of your portfolio has been the most volatile part of it. Whether there's a baton switch, maybe that goes back to equities in 2024 as the Fed steps away. I don't know.
When I think of volatility, I can't believe you guys are saying there's volatility. There's no volatility. The VIX is now at levels that we haven't seen in some time, and the vol premium, because real rates have dropped so much, I mean, now's the time to start buying puts. I think it's time to hedge up your bets.
All right.
You heard it
there
here
you go.
first.
Exactly. Although you are seeing some volatility when you take a look at the move index. Coming up, Bloomberg's Maria Tadeo on the EU Leaders Summit as they parse through some major issues, in particular Ukraine aid, but also the fiscal backdrop amid a rather hawkish ECB. Right now, a lift to markets as the pivot party turns to pivot glory. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We did not discuss rate cuts at all. No discussion, no debate on this issue. And I think everybody in the room takes the view that between hike and cut, there's a whole plateau, whole beach of hold. You know, it's like, I don't know, solid, liquid, gas. You don't go from solid to gas without going through the liquid phase.
And ECB President Christine Lagarde recovering from COVID, speaking yesterday with a scarf and taking a very different tone from the Fed. Welcome back. Tom and John are both off preparing for the holiday season. Katie Greifeld, Damian Sassower, I'm so pleased to say joining us today. But that really is what struck me, was that ultimately, Damian, she sounded like she had a completely different tone than what we heard from Fed Chair Powell. And no one bought it.
No, of course not. Well, I mean, look, you know, full disclosure, I love that she took the 10-year-old tact of trying to explain the movement from a gas to a liquid to a solid in order to explain.
I needed a refresher. So
I needed that refresher. I think that was helpful. But I mean, look, you know, the fact is, you know, how long can they hold out with the euro now pushing above 110? I mean, you know, that's going to make things that much more difficult for them to get out of the economic funk they're in. I think she's probably going to turn the other cheek.
But when it comes to sort of the fact that you had, you know, the Fed basically handing markets a gift, and then you had President Lagarde really pushing back and markets just not believing her. I thought there was a really interesting quote in a Bloomberg News article that for the time being, it's only the words of Jay Powell that carry any weight, that coming from RBC Blue Bay Asset Management. And I don't know, it's an interesting perspective that, okay, the ECB, the Bank of England, they can try to go their own way, but really it's the Fed that's anchoring things.
Which gives you a sense of why everyone focused on the fact that a couple words were taken out of the statement. The words being that inflation is expected to remain too high for too long. And this alone was enough for people to cling on to and say, they're going to cut, and they're going to cut before the Fed. There it is, right there. Bloomberg's Maria Tadeo in Brussels is going to let us know if that's the pivot. Maria, is that the pivot?
No, look, it was not. And frankly, I was not shocked at all by the tone that she took in the press conference. I think that when you look at the central bank and you know the central bank, how it operates internally, they really want to stretch for as long as they credibly, and I say credibly because there'll be a lot of question marks if we get data for the next few months the way we got today, which obviously points to an economy that is definitely softer, but they really want to stretch for as long as they can. As I say, this theme of higher for longer, higher rates, she did not want to precipitate the talk of cuts. They've never wanted to do that. They also say they want to look more into the data. When you know the governing council too and the way they operate, the idea that they feel cutting too soon, being forced, pressured, cornered by markets to do that could undo some of the work that they've done over the past year, which is not just about the monetary policy, but really the many ramifications that it's had on the political front, on the social front too across Europe. They worry about that. So I was not shocked. I think the question going forward is how long can she credibly sustain that line? And you also know very well the central bank has been criticized at times for being too perhaps optimistic on the resilience of the European economy and perhaps not being that optimistic about the transmission of the monetary policy, which shows inflation is coming down fast. So it's in that tension that will dictate the tone she takes in the next few meetings.
Well, let's talk about that tension a little bit more. And I love this quote from Christine Lagarde saying that basically the ECB, it's not time dependent, it's data dependent. But as you mentioned, I mean, okay, so the ECB, they're not going to lower their guard when it comes to inflation. You look at the data coming out overnight, though, recessionary signals there. At what point do those growth figures really force Christine Lagarde's hand here?
Yes, and if you look at it, and by the way, they always say this, they are data dependent, they do not focus on the Fed. They always say we're not a Fed-driven central bank, we respond to our own dynamics, and they genuinely believe, whether they're right or not, that inflation dynamics, growth dynamics, even labor dynamics are different across the EU. To me, it was interesting yesterday, however, and I think you really had to look between the lines and really listen to that press conference. But when it comes to the data, she did say it will guide our future decisions, and she talked about the first half of the year. I mean, this is not a story that she wants to present as a Q1 and then we see. She talked about the first half of the year. It will be data rich. That's what she said. And then that point, we'll get a bigger picture, a fuller picture of where the European economy is going. Having said that, when you get data points like the one that you had today with those PMIs, which are obviously softer, you continue to get maybe better than expected inflation prints, and that is going to put the central bank again in a position where they'll be criticized as to whether or not they're just misreading entirely the economy and the prospects for it.
Well, Maria, let's switch gears a little bit here and talk about, of course, the EU summit that's happening right now. The vote we got yesterday when it comes to Ukraine aid. Hungary sitting out, vetoing that. What is going on with Hungary? What will make Hungary budge here?
Yeah, but on that, I would say we have to be a little bit more nuanced because, in fact, you could argue Viktor Orban, he vetoed this part of the deal, but he did not veto the accession talks for Ukraine to one day enter the European Union. This accession process now sets the wheels in motion for one day Ukraine to join the EU, and that was politically very significant for the country, and there was an agreement on that, not because Orban voted in favor, but because he exited the room. I'm told at one point the German chancellor told him, if you don't agree, we get it, we understand, but we want to have a vote, do it unanimously. The best way to go about this is just exit, leave. And he left that room, and that's why this deal went ahead. When it comes to the money, however, we knew this was going to be complex. We know the 50 billion package, that is a pledge that the EU has made over a 4-year period. That was not agreed yesterday. Viktor Orban said he could not agree with the structure. Having said that, I am being told by sources today, the European leaders do believe that come January, so after the Christmas break, they will have another meeting in Brussels, and they can get this through the finish line. They also say the situation funding Ukraine does have the money to bridge this gap until they meet again in January. Of course, when you speak to Ukrainians, what they say is that they take a rather different note. When you're in a war, you want the money and the weapons as soon as you can.
Maria, I wonder if you speak to Hungarians, because after 13 years in office, I mean, many argue that Viktor Orban and Hungary are really a kleptocracy, you know, where the monies are being funneled to family and friends. I wonder, do you believe this? Or more importantly, do the Hungarian people adhere to Viktor Orban's belief that aid to Ukraine should be restricted?
It's a very complex situation because, again, it's undeniable that Viktor Orban has won the elections, has won numerous times, and obviously he is the Prime Minister of Hungary, so when he comes to Brussels, he does speak to some extent with the voice of the Hungarian people. When you talk to the Hungarians, however, there are many differences and many different opinions about what to do with Ukraine. We should also note that for all the optics, the theatrics, and even the testosterone that Viktor Orban carries, I mean, when you're in a news or in a room with him, you really feel it. But nonetheless, yesterday he was isolated on a number of topics. When it comes to the funding, I think this is also a play that he does to get his own funding and his own money. If you ask me, will there be money for Ukraine come January? I would say it's very, very likely, in fact.
So, Maria, I wonder if you could expand on that for our audience. Just let them know, like, why is the EU holding up funds to Hungary, first of all? And secondly, I guess, can Brussels actually release those funds? Is there any discussion there?
Well, the funding, look, how much time do you have? Because this is a story that goes back years. There has been concerns now, these are serious concerns, by the way, about the judiciary in Hungary, about the idea of rule of law, but also the separation of power, which the European Union has said at times has been dented by the Orban administration. As you know, there is funding that the EU provides to all countries across the euro area in a different amount, of course. That funding has been blocked for many years. Now, for Hungary, the Hungarians say they are making progress, and in fact they amended a piece of legislation 2 days ago to get the full package. They got only a part of it, and the inclination would be now that Viktor Orban would push it and continue to push until he gets the amount of money he believes he deserves. But it is a complex task for the European Union, because on the one hand you don't want to be seen as compromising rule of law and the democratic values that the EU says it stands for, but at the same time they know they have to cater to the needs of Ukraine. So again, it is being floated that if there isn't a fully unanimous deal in January from the EU, maybe they could do it at 26. So 26 countries minus Hungary. That is complicated. But as I said this morning, Europeans do say, we didn't get this deal, this package is not approved, but Ukraine can still bridge it until January, and there will be a deal come January.
Maria Tadeo, always wonderful. Thank you so much for being with us. I love that she can just drop in the testosterone that she can feel from Viktor Orban into the conversation as she heads into the next meetings. Coming up, we are going to be speaking with Julian Emanuel of Evercore ISI at a time where some people are gaming out the possibility of the S&P hitting 5,000 in the next few weeks. This from Tony Roth, Chief Investment Officer for Wilmington Trust. Katie, do you hear this as some sort of sense of, well, we have no idea at this point, given how quickly things have moved?
I mean, you have your year-end targets, but it's also the path to get there, too, which I find really interesting, especially as we pull forward this rate cut pricing. It's going to be interesting to hear from Julian Emanuel specifically about the path that he sees, because looking at his notes, it looks a little rocky.
Well, illiquid trading conditions also, so anything can happen into year-end. I'm not suggesting that, I mean, that's a huge move, obviously, but, on light volumes, anything can happen.
You think everyone's going home?
Everyone's gone home.
All right.
Except us.
Silver.
All right. Well, if you're watching from your home, welcome. And coming up, we will have that conversation with Julian Emanuel from a lovely New York. Good morning.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I think we are in this new regime. I don't think central banks have a better handle on what's to come next.
This is about inflation coming in better and the Fed adjusting as a result.
What we learned from the Fed is that we have to start entertaining our bull case a little bit more.
I think Jerome Powell is fixated on delivering this soft landing.
I've been calling for a softish landing. Now I think I just have more conviction in that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Are we there yet? It feels like the longest year ever, and I'm just talking about the past month. Welcome back. This is Bloomberg Surveillance on Bloomberg TV and Bloomberg Radio. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John are off today. I'm so pleased to say that joining me, and perhaps bad for them, really good for us, Katie Greifeld and Damian Sassower, as we parse through the rubble of a week that just totally shattered, Damian, a lot of expectations.
When you said, are we almost there yet? I thought sitting next to me, it's been a little bit too long. No, I mean, look, there's still
long enough, Damian.
There's still plenty of data to digest, and quite frankly, I mean, the way these markets are moving, I don't see how people can take a vacation yet. They can't not be in this market. There are opportunities to make money here.
Well, thankfully, it's a little bit calmer this morning. You take a look at futures right now. It's pretty subdued. I mean, we're still looking at gains. That's been the trend in the equity market. The bond market, I think we can call it unchanged. I hope I didn't jinx it, but after just a massive, massive rally, it looks like maybe we're finding a point to settle in on.
We've been talking about this for a while, right? We were settling in on a level, north of 4%. Now we're settling in on a level near 3.9%. At a certain point, have we at least found the center of gravity lower to yields, with the sense that maybe the sky isn't the limit, as everyone just sort of welcomes in this disinflation that's going to come without a hit to growth?
Well, Mira Shanda at JP Morgan FX makes a really good point. She says it's the two sides of the dollar smile, right? You've got, U.S. exceptionalism, and then, recession, everything goes to hell in a handbasket. Dollar will rally in both. But that middle ground, is very, very shallow. The markets is just going to bounce back and forth between the two. It's these two bipolar extremes that are really driving market consensus. And so that's why the range is expanding. And that's why we're not really seeing the volatility, but we're seeing the price action move all across the board.
We've been talking also about how everyone's going to be rewriting their outlooks for next year. And they wrote them 2 weeks ago. Now they need to rewrite them. And Katie, you said something really important just a couple moments ago, where you said it's the path of how you get there. That it's not necessarily just in terms of getting straight to 5,500 after getting to 5,000 by year end, as some people are now projecting out. How much are people looking for that slowdown to be the real surprise that maybe has been taken off the table for now?
Well, that's the big question. Of course, it looks like right now we're heading to a soft landing, and the start of a soft landing, it looks like a soft landing, but it can also look like a hard landing. So, I mean, Jerome Powell himself on Wednesday said that they're very aware of the risks of keeping rates too high for too long. And even if we, have to wait until March, that's still higher for quite a significant amount of time.
I want the soft landing of a mattress and just sort of falling into it again. Right now in markets, you could see a little bit of a lift after a really incredible rally this week. And it has not been a rally in S&P futures. It has been a rally in what we've seen with the Russell 2000. And the rally, in particular, the KBW index up 9% so far this week. S&P futures up about 0.25%. The euro giving back some of its gains throughout the week as people take a look at some of that negative data. 109.69. The 10-year yield, sure, stasis, but still inflected lower. And considering the fact that we started this week above 4.2% and we're now at 3.91%, that's just a week. This is full faith and credit. U.S. debt. New York crude also having a bit of a lift. Now north of $71 after people were talking about how low can it go. What we're looking at today, kind of a slower day today after a pretty wild week. Empire Manufacturing coming out at 830. S&P Global U.S. Manufacturing Services and Services PMIs coming out at 945. The economic surprises in the U.S. have started to inflect back upward, meaning that they are coming in better than expected more frequently. And Katie, again, this just sort of confirms this idea. We have a stronger than expected economy, but that's not taking away from the disinflation narrative.
And the question becomes, how do markets read that better than expected data? For so long, good news has been bad news, not to, trot out tortured phrases, but maybe good news maybe is just good news now.
So good news and soft landing, and let's just have a weekend. 11 a.m., the Congressional Budget Office will publish CBO's current view of the economy from 2023 to 2025, including updated projections. You care about auctions, I care about auctions. I think this is where people are going to start to parse through, all right, when do we have to care about the deficit, David?
Well, the big question for me isn't whether the markets are going to, whether the Fed's going to cut, it's why. What is the reasoning they're going to use when and if they eventually do cut? Is it enough to just say, oh, inflation's back below target, it's time to cut? I mean, if growth is kicking, it's going to be a very difficult, difficult argument to make.
And at 4 p.m., certainly it is. There's also the question of foreign investment and total net Treasury international capital flows get pointed to, given the fact that there's been a real question about whether they will come back, given that hedging values are a little bit cheaper. Julian Emanuel of Evercore ISI calling for the S&P 500 to end next year at, drumroll, 4750, basically where we are now. He sees a pullback in the first half that will take the index down to 3970 and then a rally kicking in, quote, prior to the 2024 election based on perceived recession trough and inflation falling to the Fed's 2% target. Julian, I'm so glad to say, is joining us now. Julian, you're calling for a pretty big drawdown. Does that mean that you're really leaning against what we're seeing right now?
Well, actually, in context of typical drawdowns, it isn't really that big, on the order of 15, 16%, which you tend to see in most years. You didn't see it in 2023, which is why the VIX is at 12. And we had this, incredibly great feeling. And obviously, we've had a lot of momentum in December. And look, the message we got from the Fed was very much an all clear. The markets responded in kind. But frankly, when you think about it and you go back to July, when we had that interim peak at the time of the last hike, in fact, of the cycle, there was that diminution of the wall of worry. The wall of worry doesn't exist right now. And so from our point of view, even if you manage to skirt around a recession, which is certainly possible, and the data doesn't show that we're in imminent danger, but even if you do, there is likely going to be a growth scare time just because there's so much optimism in the markets right now.
So that's what you think is going to crack it? Bad economic data. That is what you think is going to spur the downside, not any kind of retracement about the idea of a Fed pivot?
No, the Fed is not going to, unless the inflation data surprise to the upside, which again, it doesn't feel that that's going to be the case, though I would observe that notably, oil, among other things, have rallied quite strongly the last couple of days, perhaps in response. But no, I think that based on what we've seen, the Fed is likely going to try and be as quiet as it can for the next several months.
Does that mean that it drops out as a driver? Because you think about the equity markets, they've been so macro-driven for quite a long time right now. If the Fed really is on hold, maybe starts cutting, those rate cuts already priced in, do we start paying more attention to corporate fundamentals?
Well, look, the Fed will never disappear in this cycle because this cycle is so unusual. But you know, we'll turn the page to January. We will remember that we will have a government that will be facing shutdown. We will have elections in Taiwan, and we will have fourth quarter earnings reporting season. You know, from our view, it's not that big a deal, but bottoms-up consensus is a bit too high in terms of earning expectations. Those will be walked back. And then, as has been the case this entire year, the most important thing is not going to be what the news is itself, but the price reaction to the news. And if you think about it, all the volatility this entire year has been almost exclusively the purview of the bond markets. It's been relatively quiet in terms of credit, in terms of equity. We think that's going to change a little bit next year.
So, Julian, let's say I agree with you, and I do believe the time now is to get defensive, given where the market is, right? What's the best way to do it? Do I want to be rotating into some of those classic defensive sectors like staples, healthcare, et cetera, utilities maybe? Or do I want to be using options? Put your options hat on for me. Do I want to be buying puts? Do I want to be selling calls here? How do I protect?
So the beauty of what we've had the last number of months is that some of the more classically defensive areas haven't actually been the beneficiary of interest rates coming down and inflation coming down. A lot of other noise, you know, in areas like consumer staples and healthcare, there's been a lot of confusion and a lot of fear, frankly, around the GLP-1 phenomenon. And so people have stayed away from there. But now, all of a sudden, we're in a place where, particularly when you think about inflation, input costs into those sectors are moderating. Wage gains are starting to moderate. They are going to benefit. And frankly, the work that we've done shows that the defensive sectors, as you said, staples and healthcare, in particular the ones we like, tend to outperform on average from the time of the last Fed hike to the time of the first cut. So it's really a way to play offense with defense.
Well, to get to the second part of Damien's question, beyond just buying maybe defensive type sectors, are you looking to hedge here?
So it is something where, particularly if, and we say this very much in terms of the retail investor's mindset, is that what you want to do is envision yourself as a buyer down, call it 15%, an average type of yearly drawdown. And if you don't see yourself as a buyer because buying the dips has been a strategy that's worked our entire investment lifetimes, we don't see that changing, then you want to take advantage of the fact that options are incredibly inexpensive.
Are bond yields going to go a lot lower in the scenario that you put out?
So I think the bond yields are sort of maybe getting to some sort of stasis because obviously, look, if we do have an economic turn down or at least a growth scare, clearly that's more downward pressure on yields. But on the other hand, there's this idea that there's a secular change in international investors' appetite for fixed income. And oh, by the way, the Fed's still doing QT, so that limits any downside in bond yields.
Just to give you a victory lap, you did call the turn in small caps. It's been a rip-roaring rally over the past 6 weeks. Is it time to get out ahead of some concerns about growth?
We don't think it is, and actually it's fascinating because this has never happened before in 2023. You undercut your bear market low in small caps just at that October low, and then less than a month later, you had a new 52-week high in the NASDAQ. That kind of divergence has never been seen before in the entirety of a calendar year, let alone 1 month. And so if you think about it, even if you do get a recession, small caps have, for the most part, already been through their recession in terms of share price performance. And again, similar to consumer staples and healthcare, they're going to benefit from a labor market that's easing, and yes, the consumer still does have excess savings, which we think cushions the severity of any downturn.
Juliana Emanuel of Evercore ISI, thank you so much. Right now, we are seeing in the market a little bit of a lift to basically beyond the year-end target that Julian has of 47.85, up 0.25%. Julian, how much do you think, though, that there is enough fear that could get brought in from any weakness to give a drawdown, given that there is so much cash that's going to be pushed out of money market funds as yields go in?
Well, it's definitely going to cushion the blow. But again, going back to this idea, yes, we've more or less been promised 3 rate cuts. But in fact, if inflation does not continue that, very, marked at this point, downward path, you're still going to have cash yields north of 4%, 4.5%. And again, within the context of the last 15 years, that's still quite attractive.
Julian Emanuel, thank you so much. To me, this really is one of the key questions, Damien, this idea of being pushed out of cash. I know Tom's been really in on this, the idea that suddenly it's not yielding 5% anymore, so it's not going to be the same lure.
Crowding out, right? But I mean, what's interesting, and Julian hit the nail on the head with this, is seasonals, right? I mean, like, if you want to talk about, no one wants to talk about seasonals until it's happened, right? And you look back at October, and now from November to now, I mean, it's like a playbook, I mean, just buy in November and, ride it up through January into February and, sell in May and go away.
Are we going to talk about the Santa Claus rally at any point, I wonder?
No, we're not.
Good.
Anyway. were you hoping
just
we were going to?
not to?
Yeah,
Would it be cool?
yeah.
Okay.
If you want to talk about it, you go for it. Do you want to talk about it? Do you have something to say?
Not a burning one.
All right, well, we'll get that to you, the burning take on the Santa Claus rally and what else we can call it. Coming up in Bloomberg, in Washington, D.C., Bloomberg's Mario Parker. That's next.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What needs to happen to end the war today is the conditions I just laid out. And there's 3 of them, and they're not that difficult. Lay down your arms, turn over those who were responsible for the October 7th attacks, and give up all the hostages. 3 simple things, and this thing could be over. Could be over today.
That was John Kirby, National Security Council spokesman, talking as the U.S. administration does shift its tone just a bit with respect to the Israel-Hamas war, really warning Israel against going forward with the same type of airstrikes in terms of the same pace, at least, going forward. Welcome back. This is Bloomberg Surveillance. Katie Greifeld, Damian Sassower here with me today. And Damian, I've got to say, it's been so sort of distracting and such a focus point to keep watching the tit for tat and just wondering, when is it going to be over?
Yeah.
When can we move on?
Well, I mean, your guess is as good as mine. I mean, certainly the American war machine is back up and running. The amount of money the U.S. is spending on defense, most since, I think, 2019. But, Biden's $106 billion request, not coming through, the EU not coming through with funding for Ukraine. I mean, this creates a lot of just a lot of noise amongst all of the other stuff we're seeing in terms of geopolitics globally.
I'm glad that you mentioned the defense bill. It does look like they might be able to get something passed, which was a surprise. It means that President Biden is going to cater to certain aspects that will anger some of the progressives, but that also Republicans really isolated some of the more fringe members. And I want to go there with Mario Parker, who is in Washington, D.C., is Bloomberg White House and politics team leader in Washington. Mario, what do you make of that, the sort of coming to the middle that you're seeing to get some sort of military aid passed?
Yeah, well, you're saying, you saw earlier this week, Zelensky came here to Washington, D.C. to put a little bit more pressure, particularly on Republicans as well. You're saying the Democrats, you're saying the Biden administration makes some tough concessions that they had been holding on to. We're talking about maybe discussions about immigration reform, border reform, et cetera, in order to get that aid. We know by and large there is support for Israel, but to your point, the point that you all just made, the continued aid to Ukraine without some of the preconditions has been a sticking point.
Mario, Trump flipped Michigan in the most recent poll. Now all 7 swing states are in favor of Trump, according to our last Bloomberg poll. I mean, talk to us about those poll numbers. What is driving that? Is it Israel-Hamas? Is it, geopolitics? Is it domestic economic issues? Or is it something else like, right to choose? I mean, what are your thoughts there?
It's a little bit of everything, right? But the main thing is the fact that Americans, by and large, feel as though the economy just isn't working for them right now, right? You've got, which is a contrast and a frustration for the Biden administration. Every week it seems like they're getting some type of positive economic indicator data coming in, but Americans just feel just very glum about the economy, and they're giving more credit to former President Donald Trump, right? So for the Biden administration, there's this frustration that there's this amnesia, rather, about the Trump years, this angst that they were able to stir in 2020. They're just not seeing that right now on the ground in some of these key swing states.
Well, Mario, what's going to be interesting in this election year is, in addition to actually the issues, we have both the president and Trump basically facing a lot of legal issues themselves, right? Talk to us a little bit about that timeline. Like, what should we be looking out for regarding, Hunter Biden, regarding Trump? I mean, what comes next?
Well, with Hunter Biden, we saw him in the Capitol earlier this week, kind of playing a game of chicken with House Republicans who are trying to make him the focal point of investigations here. Some of that is a reboot of what we saw in 2020, where he, in the final stretch, he was a main topic of discussion as well. That portends to be, that'll be the case. He'll be front and center over the next year or so with some of his legal troubles. At the same time, for former President Donald Trump, what we're seeing, even as he's seems to be cruising toward the GOP nomination, he does have to have several knockout blows in the primaries earlier next year. That's talking about Iowa, New Hampshire, and South Carolina, right? Because what happens in early March, just around Super Tuesday, is he's set to have his first court date for some of the election, his actions around the 2020 election.
Well, in the same way that Donald Trump's legal troubles haven't seemed to impact his campaign at all, his popularity with his base, what do Hunter Biden's legal troubles mean for the Biden campaign, if at all?
Well, the Biden campaign, at least right now, is signaling that they had one of their best fundraising days right after the Republicans this week kind of targeted, re-upped their targeting of Hunter Biden. So for them, they're trying to spin this into a positive. They're actually, what's ironic about it is they're taking a page out of Donald Trump's playbook, right, where you would see his court appearances or indictments coming in, and then he would say that he's raised X amount of money as well. But otherwise, the White House, what you're going to see is you're not going to see Hunter Biden, prominently and displayed with campaigns or anything like that. They're going to try to compartmentalize it. They're going to try to say, again, similar to what Donald Trump is saying, that this is politicized. This has nothing to do with the president. The president had nothing to do with Hunter Biden's troubles, and that the voters shouldn't hold that against him at all.
And of course, looking forward to the 2024 presidential election, Bloomberg News broke the story this week that you take a look at Donald Trump's campaigns. There's plans there to significantly ramp up their activity in Iowa during the first 2 weeks of January. And as we finally flip the calendar into 2024, how quickly might we expect the GOP field to shrink at this point?
Well, we could see it shrink pretty quickly, right? I mean, polls this week showed that Donald Trump has about 51% of the vote in Iowa. Nevertheless, and this kind of goes back to just the calendar, the legal troubles, et cetera. Nevertheless, you see him kind of keeping his foot on the gas in a state like Iowa because he needs to sew that up pretty quickly before he's pulled off the campaign trail and having to spend more time in the courtroom, right? What we could see in this unique election where it looks like we're going to have a rematch of a 2020 election, what we could see is the longest general election that we've seen in modern history, right? If he sews up Iowa in January 15th, if he sews up New Hampshire, if he sews up South Carolina with really resounding wins that back the polls, then we'll see a general election fight where he's pivoting to Joe Biden and Joe Biden's pivoting to him. We're talking about like March and April.
Which is exactly,
very early.
I'm sure, what everyone wants to see, the longest general election in history with two candidates that no one's particularly excited about, according to a lot of the elections. Mario Parker, I'm curious about the possibility of third-party candidates. We always talk about this. It never actually gains any traction. Is this year different?
No, this year is different, right? And it kind of gets at what you just said, right? Americans really are dissatisfied with the two choices they have before them, and so they're looking to some other arms, right? Not necessarily that a third-party candidate will win the White House, but they could very well play spoiler, and a lot of that is because of the dissatisfaction that voters have with both Donald Trump and Joe Biden, right? So you're saying some of these if the election is anything other than the rematch between two of these folks, the other thing is this seems to be the election of the third-party candidate, right? You're getting a more crowded field of third-party candidates than we've seen in recent years.
And then we'll have to look through in terms of how many votes they take away from each of the candidates. Bloomberg's Mario Parker, thank you so much. Are you excited for this, Katie?
I am kind of excited. I know that you just made the point that these are two candidates no one's excited about.
Not many people.
Not by the people, but when you think about just all of the geopolitical issues that are in the world right now, you think about domestic voters who tend to be very focused on domestic issues. It's going to be interesting to see the messaging from both campaigns, how they try to tread those lines.
Well, I hate to channel Chair Eccles here, but the reality is, this is an election year. So, the fact that the surprise that, Chair Powell was so dovish heading into 2024, a lot of people might be drawing corollaries between the fact that, hey, cutting rates in an election year is not necessarily something we haven't seen before.
Well, a lot of people were talking about that yesterday. Is there a coincidence that he totally shifted gears in 2 weeks after Janet Yellen came out and said the same thing and sort of speaking from the same hymn book? The issue that I have, and just sort of stepping back from that particular back and forth, which I'm sure we'll be analyzing for a long time, is that we haven't heard President Biden be able to celebrate an economy that actually looks like it's achieving what nobody thought it could. Yep. And this is sort of the perennial frustration that we're seeing increasingly from the administration. Why aren't you giving us a victory lap? And then in the satisfaction polls, you're not seeing it, which raises this question, what's going on? Why are people feeling so bad? You can't just discount people's feelings and say they're not valid.
No, well, I mean, look, it's difficult to tell what the majority of Americans are even thinking on many of these topics. So I think that therein lies the rub.
And a lot of it is just in terms of the level of inflation that's been coming up. Coming up next is Earl Davis of BMO Capital Global Asset Management on fixed income. Does he still see higher yields from here?
the reception, the acceptance of Purosang has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosang all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million cars every year.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Whipsawing into the end of the year, trying to get a new bearing after a Fed pivot turned into something that looked glorious for the bulls and really problematic for the bears. Right now, we're seeing a lift to markets as we tread into the end of the week, the end of the year. 47.85 on the S&P, up 0.25% after more than 2% gain. The Nasdaq actually regaining a little bit of its steam, up about 0.3%. And you're seeing the Russell 2000 again, and Katie continuing to outperform, up 0.8% after already gaining north of, I believe, 5% so far this week.
Yeah, as I was saying earlier, I mean, I hadn't looked at the year-to-date chart of the Russell 2000 in a hot minute, and the line has just gone straight up. The outperformance of small caps has been really breathtaking when you think about especially what a terrible year they've had up until really mid-October, early November.
The other thing that's been a straight line up has been the KBW index of banks. You've seen that increase by about 9% just this week. I mean, talking about a week as a month. And Damien, we take a look at the bond yields. Yields have come in, and that has been what's fueled everything. 2-year yields, 10-year yields, 10-year yields going down by more than a percentage point since the middle of October. How are lower yields good for banks?
Yeah, Lisa, no, you make a great point. I need to refresh and look at how equity income yields are comparing, how dividend payout yields are looking relative to fixed income in lieu of the recent move we've just seen. Because we were pretty close for a while there. Obviously, bond yields have become higher than dividend payout yields. But I mean, like, my goodness, it's been such a quick move so fast. It's interesting how equity investors are looking at this.
Well, you bring cash into the conversation. I mean, cash has been the biggest competitor for about every asset class going back at least a year. So now that we have the markets really in love and fully bought into the fact, this idea that we're going to get meaningful amounts of Fed cuts, do we finally start to see that $5.86 trillion start to make its way out of money market funds?
Yeah, no, I mean, money market funds still have a lot of powder to put to work. But the question is, it's year end. Obviously, it's really going to be more of a question for January as we kind of look ahead to the new year. I mean, just how many people are going to reach into their pockets or reach out of their money market funds and try to chase. So we'll see.
It also is curious because people are trying to game out, can they spread from the U.S. to the rest of the world? Is this a lifeline, as Bill Lee was saying from the Milken Institute, in terms of what the outlook is for China, what the outlook is for emerging markets, your territory,
runway for dollar weakness,
as well as for the euro. What you can see today is a bit of dollar strength. And this, to me, is interesting because a lot of people are talking about, okay, dollar weakness here to stay with the pivot there, but not the pivot, the ECB or the Bank of England. And yet today people thinking, well, maybe the economy matters again.
Maybe it does. And it's been interesting to see where that dollar strength is coming against this morning, coming against the euro. The euro was having a pretty good week up until the last few days, especially when you consider the Fed and the ECB. But I don't know, this dollar, it feels like we've been calling its death for a long time.
Currency movements this year to date, has been a carry story. It's been about yield differentials, right? And since, I would say, June, we have seen that kind of fizzle away, right? So now what comes next, right? Do we see the shift toward growth? Do Do we see the shift toward value? I mean, what's going to be the next driver of currency movement? Because clearly rate differentials have compressed a bit and are moving in a different direction, and certainly the euro still has lower yields in the U.S., yet it's rallying versus the dollar on forward expectations. Something interesting here.
Let's talk about the European Union. Under surveillance this morning, EU leaders agreeing to open membership talks for Ukraine, but failing to back a new aid package, sending the debate into early next year. The $54 billion package was backed by 26 of 27 members. There was one nation standing alone. It was Hungary that opposed the funding. And we were talking about Viktor Orban and some of the colorful language that we heard from our colleague over in Europe. But I am wondering whether this really does leave Ukraine kind of in limbo heading into a winter, especially, Katie, as Russia really ramps up their financial support.
Absolutely. I mean, it's Hungary that's the odd man out here, but that, of course, is gumming up this aid from the EU. You think about what's going on in the U.S., unable to pass an aid package there as well, and it's creating a lot of really, really tough questions for Ukraine as we get into 2024 and potentially another year of this war.
Well, let's talk about Hungary for a second, because this is kind of my, realm of expertise. Hungary is one of the inflation in Hungary is the fastest you're going to find in the Eurozone region, right? And the interesting thing about it is a lot of voyeurs, I'm talking fast money investors, go into the front end of Hungary and basically take advantage of those high yields. And sometimes they even do it on a currency hedge basis, but this year not so much, because the forint is one of the top performers on the year. But nevertheless, what's to say that those foreign investors that are propping up, the Hungarian fixed income market are going to stay there forever? They're only taking advantage of the yields in the front end. If yields start to come off, where are they going to go? And if Hungary isn't playing ball with the rest of the EU, what's to keep them invested?
I love you. You come out and it's like, it's all about the fixed income market. Viktor Orban is going to get disciplined by fixed income market. We'll discuss. Citi, meanwhile, to just shift gears a little bit, shutting down its muni business, saying in a memo to staff, quote, "It's no longer viable given our commitment to increase the firm's overall returns," the move impacting about 100 employees, according to people familiar with the matter. Citi hopes to complete the wind down by the end of the first quarter. There are two things here, and Damien, I want to get to you with your intimate experience of working at Citigroup. But Katie, there is this issue of prioritizing the appearance of backing roads and tunnels and some of the conflicts that have come into play in Texas versus the just sort of getting in the black, getting good profits, which definitely has been Jane Fraser's main focus, and just stripping away businesses that have not been outperforming.
Oh yeah, Jane Fraser has been absolutely ruthless in her path to drive profit. This was shocking. I'm not quite as intimately acquainted with Citigroup, but I did cover munis for a hot moment a few years ago, and I mean, Citigroup was so dominant in the muni market. The fact that they're completely exiting this business, really shocking people in that market, which it's a little sleepy, but we're talking about $4 trillion here.
Well, I think a lot of it has to do with the fact that, quite frankly, there's just a scarcity. There hasn't been all that much issuance. I mean, the reason munis do well is because it's a scarcity play. There's just not a lot of municipals out there. But what you're really drawing me in on is my time at 388 Greenwich at Citigroup's headquarters downtown in Tribeca, when the muni guys were the ones who had ground floor access. Their entire group was separate from the 6th floor and the 7th floor and the rest of the firm. They had their own little place where they hung out and did their thing, and they were awesome, man. They killed it. They crushed it.
They killed it, or is this resentment?
A little bit of resentment.
I mean, come on. They killed it. They were really great, but they had ground access.
I will say that Citi is Mike Mayo's top pick for 2024. Go figure. Yeah.
Well, there has been a lot of restructuring, and Jane Fraser has been reviewing everything, and there are no sacred cows, and that was made clear. Meanwhile, this story is one that I know is generating a lot of discussion for a lot of people at their dinner tables, potentially for sons who are Mets fans who feel like it's completely unfair that the LA Dodgers have such an incredible advantage. Shohei Ohtani wearing his number 17 Dodgers jersey and speaking to journalists for the first time since signing his record contract. Ohtani talking about the contract, saying, quote, "I felt like it was like that was worth it, and I was willing to go that direction." The reigning AL MVP agreeing to a 10-year, $700 million contract. Hold on a second. You might say, oh, yeah, that's worth it, you think. But he'll only be paid $2 million a year for the next 10 seasons, with $680 million deferred until the end of the deal. I do just have to say, on behalf of my older son, who was ranting about this, saying that it's completely unfair because suddenly the Dodgers can have an entire budget to go out and get other superstars and create this incredible team without having any kind of cap, because they're only paying $2 million a year, and then it's completely going to undermine the chances of other teams like the Mets of doing anything.
Well, that's not entirely true, and I'll tell you why. Because even though it's 10 years, $700 million, that's $70 million a year, $680 million is deferred, they are charged $46 million per year against the cap. So they still have to put $46 million, I'm talking the Dodgers here, in escrow each and every year for the life of his contract in order to be able to pay him in 2034 when he eventually starts getting paid. This is really a tax play. Katie, this is really interesting because in 2034, Ohtani will be 40 years old. He probably will be out of baseball, and he probably won't be living in the state of California. He'll probably be living in a tax-efficient jurisdiction like, I don't know, maybe Bermuda or the Caymans, where he doesn't have to pay tax on that money. So to me, this is more of a tax play than anything else.
This has been a really fun story this week because I went into it thinking I was going to learn a lot about baseball, but actually I just learned a lot about taxes.
That's so totally true. Yeah. I also learned a lot about the pricing cap and the sales of jerseys that are just off the charts and just how big that audience is in Japan.
Talk about scarcity and demand.
100%.
Let me add one more point that John Authors made, which is a very interesting point, because in Japan we have negative rates going out as far as the eye can see. So from Ohtani's perspective, as a Japanese, a Japanese citizen, is what does time value of money even mean with negative interest rates out to infinity, right? Like, I get paid for deferring my money as opposed to having it in hand. It's a very interesting dynamic.
Either way, I think it'll be a really interesting season, and I just got a message from someone indicating it's not as if the Mets have no money also. Right. Meanwhile, we are seeing some earnings coming out. Earlier, just this hour, we heard from Darden and the breadsticks at Olive Garden coming out. Basically in line, you are seeing the shares a little bit lower. You are seeing bars and restaurants stay busy this holiday season, despite expectations that retail sales would slow. Food services and drinking places are up 11% from November of last year. But data from Black Box Intelligence says diners are skipping family meals and fine dining, opting instead for cheaper and faster options. I understand this, looking at some of the bills that I've gotten. Michael Halen, senior restaurant analyst for Bloomberg Intelligence, joining us now with more. Do you have a sense of just what a downgrade means? Does it mean that basically McDonald's and Olive Garden are doing great at the expense of more bespoke and higher-end restaurants?
Yeah, I mean, that's what we're seeing this year. In a slowing consumer environment, and that's what we are seeing with restaurant spending in the second half of this year. It continues to slow. For a lot of reasons, but a big one is just increased consumer debt. That's how people have been dealing with higher inflation, right? They've just been opening credit cards, racking up a balance. Rates are extremely high, and so we see a consumer that's kind of strapped. We've kind of put it, Darden's kind of. They're well diversified. They have high-end restaurants. They have cheaper places like the Olive Garden and Cheddar's. Kind of what we've been arguing is that, in a slowdown and in a potential recession, what we're going to see is more people going to quick service, because you'll have a lot of people saying they want to save money, and they can do that moving from full service, from one of Darden's restaurants to a McDonald's, right? You're not paying for the tip. You're not buying appetizers, so it's a lot cheaper. So we've seen that. The November sales data, industry sales data that we get from our partner Black Box Intelligence really bore this out. We saw over 100 basis points of sequential improvement in the quick service same-store sales, and we saw a similar decline in same-store sales at casual dining chains we cover.
And Michael, is this playing out according to script? Is this how it usually goes when you have consumers and diners really worried about inflation and, frankly, feeling miserable about the economy, that they opt for those quick service options?
Yeah, kind of the way to think about quick service was like customers fall into that bucket and fall out of that bucket, right? So the low-income consumers are probably gonna eat at the grocery, cook themselves, shop at the grocery store a little bit more, and make their own meals a little bit more frequently. And we've had some of the quick service names that we cover actually talk about that on this latest quarter. But at the higher end, you'll see more upper middle income consumers and high end consumers actually try to save money by eating at a quick service or a fast casual restaurant more often. What we've heard is that a lot of U.S. consumers are cutting back at some of their higher cost independent restaurants and eating at fast food a little bit more. And what we do see in the data is that fine dining has slowed significantly. It's down, 7 straight months, I think now.
If you are... If you are just joining the program,
been-
the S&P up about 0.25%, but Damien has some pretty strong feelings on fast food, so come on in.
No, I do. But usually when Michael and I speak, we talk about, Suns lacrosse game. Instead, I'm going to talk about Texas Roadhouse, Michael. It carries the highest PE multiple 21 times in full-service restaurant land. What are they doing differently compared to Darden, Cheesecake, and the rest?
They're growing, and they're growing aggressively, and Wall Street loves growth, Damien. I don't need to tell you that. So, yeah, they do a phenomenal job, man. There's a lot of value on the plate there, so you get a lot of food for the price that they charge. It's an experiential type of place, right, where there's line dancing. It's a very popular place for birthday parties and occasions. So they've done phenomenal, man. So there's a lot of growth, both through same-store sales and through net unit growth. It's a very entrepreneurial culture there, and they've done a phenomenal job.
Michael Halen of Bloomberg Intelligence, thank you with the line dancing at Roadhouse Steakhouse. Is that your favorite?
I like the line dancing. Yeah, no, Michael and I like to go line dancing on the weekends.
I could see that. I could see that. It's cute. Thanks. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Are we going to get that pullback? Or actually, do you just need to look at the bond market today and say, you know what? 4%, that's not too bad. I still think you do need to be slightly concerned about the supply that's coming. So more intermediate bonds make a lot more sense, I think, from a kind of risk reward standpoint. But we are in an environment which should be pretty good for the bond market.
That was Ian Steely of JP Morgan Asset Management on a view that pretty much everyone seems to share right now, considering the rally into bonds. Good morning, welcome back. Damian Sassower, Katie Greifeld, Lisa Abramowitz, John and Tom, both off today, and we are looking at the pivot party, expanding out to all of the different asset classes as we try to understand how long this can last. I want to get right to it with our next guest, who had a pretty bold call the last time he was on, talking about the potential for yields going to 6% on the 10-year. Maybe not that, but he still is a bit counter consensus. Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, do you still see yields going higher from here, even retesting some of the levels that people have basically said are in the background?
Yeah, and you know what, I'll start with, I think 2023 is going to be an extremely informative year for 2024 yields. And what I mean is, if you look at the low close on 10-year yields, is roughly 350. If you look at the high close on 10-year yields, it's roughly 5%. We're of the belief that this kind of volatility is going to continue, and we're going to test both the lows, 350, and we think that's a Q1 story, and the highs, 5%, and we think that's a Q2 story. A lot of the drivers for higher rates haven't haven't left the market, right? We still have supply, we still have inflation. I've been in the market since 1994, and I know at any given point in time, the market looks at one thing. So now we're looking at the one thing that gets us to 350, and then it'll revert to the other issues that haven't been solved.
Earl, you have to clarify for me. If we're going to see that type of volatility, that type of movement in U.S. Treasury yields, what does that mean for the plumbing of financial markets? Talk to me about the reserve repo facility, the general account. Like, what comes next? I mean, how is that going to manage through?
Well, the plumbing is fine. And remember, I said the volatility that we expect for 2024 is the same volatility we had in 2023. Yes, the Fed brought in some additional facilities, but now that the plumbing, the foundation is solid. And this is an interesting thing. We've been tracking volatility in 2022, and we track it in a simple manner. What's the absolute yield move? So bonds are up 1 basis points today, down 2 tomorrow. That's 3. 2022 was the most volatile year in the 2000s. Except for, you know what? 2023 is now going to be the most volatile year, an absolute yield move. So there's no reason for that to stop. There's such a dispersion of views out there, incredible views, plausible views, that, you know, it's a tug of war between these. So we think we'll continue to see that. The plumbing is fine, and we'll be good.
And what about demand? I mean, do you? What are your thoughts on the market's ability to absorb all the supply that's expected to come through during the first half of next year?
Well, you know what? That's why we expect us to go back up to 5%. The market ability, here's an interesting stat for you. Since 2007, the amount of treasuries outstanding has increased 5-fold, 5 times. The amount of capital at dealers to support that inventory make markets has increased 2-fold. So what that tells you is you get broader, wider moves for any given piece of data that comes out, which is why we're getting these type of moves right now, which is why we'll probably test 350. And the high likelihood we go back up and test the highs again.
Well, let's bring this conversation about demand to the very front end of the curve, to money markets, because there's $5.9 trillion or so sitting in money market funds right now. That bid has just been unstoppable in 2023. Looking into 2024, do you think there's still going to be that really heavy, robust demand for cash?
Yeah, definitely. That bid will continue into Q1. I think that bid, as you stated, goes into fixed income because once people get their statements and see that bonds are actually up this year, which they are now, which is different from October, they'll feel more comfortable buying more bonds. And we think that's like I said, a Q1 phenomena. And once that subsides, then the supply issue, and we still have inflation. We haven't even spoken about inflation. Right. All those UAW wages, they kick in January. Government employees get a 5% plus increase in January. The defense bill that came out this week has a 5% increase for service persons. There's a lot still there in the background, but we're not focused on that now, and I understand that. And that's how the markets operate.
Well, when it comes to the inflation picture, you think about the Fed's resolve to bring inflation back to 2%. It was interesting listening to Jerome Powell on Wednesday saying that so far the reduction in inflation, it's come without job losses. And then you think about the last mile of inflation, and he said that he's reluctant to say that that will be a painful process. Is that your read as well, and is that your read for the bond market?
No, it will be painful because that last drive down in inflation won't come unless unemployment goes higher. And the reason why that is, the two most sticky elements of inflation, which is keeping it above 3%, is one, wages. So as long as people are unemployed and the labor market's tight, which arguably structurally is, people will continue to get their paychecks, which adds to excess demand. And not only will they get their paychecks, based off of the strikes in 2023, they're more emboldened to ask for more money. That's one thing. The other thing, too, is if they're employed, they're still going out and buying. Yes, they may be downgrading or going down to less expensive restaurants, but they're still spending. And that is directly related to employment. So soft landing assumes that employment stays very high, unemployment doesn't go that much higher, which means your services and wages are going to be extremely sticky, and it goes. One last thing I want to say, when I look at inflation, I look at the 70s. In the 70s, you had 3 peaks of inflation. The first one was roughly 6.2, call it, came down to 3-something, went back up to 9, came down, went back up to 14 before Volcker came in. We've just had one peak here. So this is a secular trend. It's all not going to happen in 2024. It's not our expectation. But over the next 3 to 5 years, the grind is higher.
which is going to be a lot of fun for people who are getting used to or not getting used to the whipsaw action. Earl, if you're looking at a band between 3.5% and 5%, how do you play that? What do you do?
Oh, great question. I love this question. You know what we're buying now? And I've said this before, we're buying real yields. We're buying tips, 10 and 30-year tips. They're still 180 to 2% yields on backups. We love them because we think the financial conditions easing is an underpins inflation, possibly pushes up inflation expectations. So your real yields will outperform in that environment. So right now, we've been bearish for the past 2 years. Quite honestly, we played the market from the bearish side. 2024, we're going to play from the bullish side until we touch the 350 level. So on pullbacks, we will look to buy real yields is what we like. And if you're thinking the opposite way, another thing we actually just did, we just shorted U.S. two-year bonds, discounting 165 basis points of eases by January, 150 by December. It's plausible, but we like that tailwind of being short. You actually make money if nothing happens. So we think that's a great tactical trade. A great structural trade is buying real yields and tips on pullbacks.
That's pretty bold to outright short 2-year yields. How do you do that without losing so much money that it could really hurt returns?
Well, think about it. When I say there's 165 basis points in eases discounted in 2-year bonds, that means they actually have to ease by more than that for you to lose money. And the other thing that's enticing about this is that it's discounting eases starting in March. So if they don't start March, even if it's summer or later, you make money additionally. So, as a long-term investor and asset manager and an active manager, this is why it's so important to go into active management now because of these things. You have to say, where does the math make sense? Where does your forecast look? When it's different than the market expectations, that equals opportunity. So that's where we see opportunity tactically, which means it's a smaller size trade. Structurally, we like buying real yields on backups, and we still like credit. The economy is going to do extremely well and resilient in 2024, so we like buying IG credit and BBB and picking away at some high yield as well.
Earl Davis of BMO Global Asset Management. I love listening to what you have to say because it's always a bit counter consensus and bold. Earl Davis there from BMO. You're nodding along, Damien.
Well, no, I agree with what he's saying on tips. I mean, certainly the move lower has been driven by real yields, not break-evens. But, IG credit, IG credit's up, 7% this year? I think high yield credit's up 11%, in an environment where, we're getting, if you think we're end of cycle, and spreads haven't really reacted to that. I don't know about that one, but look, he's a braver soul than I.
A braver soul, especially when it comes to the front end, outright shorting
and the two-year
yields. It seems brave, but then you remember, of course, you still have that very lofty yield. You're still clipping pretty meaningful coupons there. It would take a lot to lose a really, really painful amount of money.
And just to sort of build on what you're talking about with investment grade credit and this question of whether spreads are too tight or how will you get value, investment grade bond spreads, the extra yield over benchmark rates is the lowest level going back to January of last year. That's where we're at. It is less than 1% above the benchmark rates. That's amazing.
It's tight.
Well, and this is really is going to set up our conversation. Coming up next, Michael Purvis of Talbot and how much you play into the pivot party, how much you join, how much you bring someone, or how much you try to maybe leave early. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities
are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I really wanted to pull back. I thought we'd had this great run, but as I look at what the Fed did, I think you have to keep these positions.
I feel like the roles are a bit reversed now, where central banks are taking the big calls, and then the market is now running even farther ahead.
I still think it's going to be dependent on the data.
We are making this call that the earnings recession is likely over and that we're going to see rolling earnings recoveries.
I just feel like we need to get through this bout of disinflation first before we talk about what happens next.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Is it FOMO or no-go? I couldn't resist. I'm sorry. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow are off, and of course I'm misbehaving. Joining me, I'm very glad to say, is Katie Greifeld and Damian Sassower as we plow toward the weekend after a crazy week. And honestly, I know it's cheesy, etc., but a lot of people are feeling FOMO right now. And then we just heard from Earl Davis, maybe not.
Yeah, leaning against it, outright shorting 2-year treasuries. I'm still stuck on that, Damien. I know you're excited about his tips and real yield call, but
I'm not even thinking about shorting 2 years in this market.
Why?
I mean, God bless him.
Well, okay, hold on a second. This idea of trying to lean against the freight train that is the fear of missing out. Give us a sense from all of the hats you've ever worn of how hard that is.
Well, I mean, look, you got to think about things like carry. You got to think about the cost to short, right? And I mean, look, the 2-year yield is not what it once was, right? So, you know, to hold that position on the mark-to-market losses you might get from the roll down it just makes it a very difficult trade from a P&L perspective.
Let's just reset here and talk about why we're talking about 2-year yields. They are down from recent highs on October 18th of 5.2%. They are currently 4.38%, almost 80 basis points of a decline in less than 2 months on the heels of what a lot of people said was a dramatic pivot from Fed Chair Powell, complete 180 in terms of his tone, really opening the door and solidifying the market's belief that the Fed will cut rates as early as March March next year. Katie, how much can people move against this idea of immaculate disinflation, of the fact that maybe it was just transitory when it's being basically supported by the Fed chair?
You know, the question that I've been playing with over the past few days is it seems like fighting the Fed actually worked this time, that you had all of this rate cuts pricing come into the market. You had Powell and company pushing back right up until the blackout period. And then, I don't know, what we came to this Wednesday, it was a completely different Fed chair.
Yeah, I mean, last weekend when I was listening to Bruce Kasman and everybody out there, I mean, they were saying, all the talk was just how are they going to maintain a little bit of a hawkish tone amidst what's going to be a dovish meeting. They didn't even try to maintain a hawkish tone. It was all doves, all day, all the time, and it's just took the market by surprise.
New York Fed President John Williams is going to be speaking in a bit, but I am curious to see what the pushback is going to be heading into the end of the year, whether we are going to see any kind of walking back. Without that, could anything change, Katie, heading into an otherwise sleepy 2 years, 2 last weeks of the year? I want to say 2 years of the, epic.
Yeah. No, it's a great point because how it typically happens, you get the press conference, and then the weeks that follow, you have all of the FOMC members coming out, all the Fed speak either endorsing that message or trying to walk it back, trying to fine-tune it.
Well, usually, I mean, you would think that volatility would pick up given the level of uncertainty that's out there right now, but it's not. And quite frankly, if you look at history, it's not expected to. I mean, you usually get periods like this after that last hike, if we've indeed peaked, where you get this kind of dribble down in vol for 3 to 4 to maybe even 5 months. If that's the case, it's risk on.
Well, and vol has been going absolutely nowhere. Taking a look at the VIX index, it's close to the lowest going back to November 2019. Let's take a look at the scores right now. You can see the gains retracing just a bit, maybe on the 2-year call that we just heard from Earl Davis, 47.80, up about 0.1%. The dollar giving back, or actually reclaiming some of its lost ground to the euro, but still a pretty tremendous rally for the week for the euro, 109.42. This really, again, the divergence between central banks, a real question about how much people are actually buying it. I don't know, Damien. The fact that everyone just completely discounted what ECB Chair Christine Lagarde was saying is notable to me.
Well, I think it was the scarf, right? I mean, people really didn't buy into the. I'm kidding. No, she had a cold.
COVID.
She had a cold. Oh,
I felt for her. Yes, she said she came out and she said, "Bear with me. I'm recovering from COVID."
Okay.
So she didn't have the same kind of
she
strength.
Looked very chic.
She looked great.
I liked this.
She did look chic, but she didn't have the same kind of vigor.
I didn't hear that.
That's.
Okay.
But
Sorry,
anyway,
Christine.
what were you going to say?
Yeah, no, I'm going to apologize.
You're gonna say something.
I just think it's really interesting because you don't see central banks, especially developed market central banks, counter the Fed. You know, we're all living under this world where we think everyone follows the Fed. All central banks follow the Fed, but for the ECB to kind of take a bit of a different tact here, that stands out in my mind.
And how long can they do that, though?
Yeah.
I mean, the conversation we were having maybe an hour ago, they're breaking ranks right now, but especially when you think about the economic situation over in the Eurozone, at what point does that growth picture kind of force Christine Lagarde?
Well, the ECB doesn't care about growth, Katie. Remember, they just target pricing. Correct.
Well, and I think a lot of people aren't buying it.
And the Fed doesn't target financial conditions either, by the way.
3.9%. Actually, they didn't seem to in this last press conference. Joining us now to weigh in on all of this, Michael Purvis, founder and CEO of Talbot and Capital Advisors. Are you a FOMO kind of guy?
Well, I am right now, certainly. Look, I think Damien was talking in an earlier segment about the seasonals, and you absolutely have to look at them. When the market is up, what it was year to date coming into the Q4, you could check a couple of boxes. Do earnings need to be pretty good? Yeah, they checked that box. Did rates get contained when the 10-year was spiraling up to 5% and possibly beyond? Sure, they got contained. And add onto that a softer dollar, and you have those 3 boxes checked. Then you have the FOMC, and then you have a lot of catch-up. You have, one of the things with all these crazy market movements is there's been a lot of positioning underneath this, right? A lot of people were way offsides coming into this year. Very bearish equities, perhaps bullish bonds, because there was a recession call. And we forget sometimes how important that is in sort of lifting those things. But for the here and now and to the year end, look, I think 4,800 is even fresh lifetime highs in the S&P 500 is a real scenario here. I'm actually, I've been bearish VIX coming into December, 12-handle VIX, then 11. I actually think we could see a 10-handle VIX. I'm trying to figure out what the volatility catalyst is between now and the end of the year. It's everyone's going to be going on vacation, and any kind of dip you're going to see, I think it's pretty well bought here.
Well, let's talk about the VIX, because you make a great point. The VIX is now just above 12. You know, levels of implied volatility have come off significantly. Sure. But you point out, interestingly, because I read all of your work, that realized vols come off also quite significantly.
Yeah.
So the vol premium is still there for you to perhaps still want to write protection as opposed to buying protection. I'm curious, what's the move you want to make in this market right now if you want to get defensive? Am I buying puts or writing calls?
Well, that's a great question. Actually, I think the best trade, I don't think I'm pulling the trigger on it just today, is not SPY or SPX puts, but really rather VIX calls. Because I think what's going to happen, one of the things that's underlying this market dynamic is that there's a lot of rotation, right? And I think if you have rotation, you can see the S&P 500 being kind of like supported. You may not get the big down move that you need in SPY puts, but you know, if the VIX does get to 11, right, and you get some sort of just anxiety as we get through this sort of hangover from this rally, and which is, I think, pretty, you know, inevitable, you know, in the late January, February timeframe. You know, you don't, if you buy, a VIX call, you know, at $1, it can get to $2.50 pretty easily, whereas the SPX put can just kind of melt away. And so I think that's my preferred way to play this. But I think I'd probably pulling that trigger in a few days.
So, Michael, conceptually that makes a lot of sense. But besides you, potentially in a few days, besides Damien, is anyone else hedging in this market? What does demand for protection actually look like here?
Well, you know, I think a lot of the put call skew has failed to really, you know, be elevated through so much of this rally, through so much of this year, quite frankly, right? And, you know, you have seen this, you know, big growth in option usage there, and I think that's sort of an interesting structural component that has a lot of implications for distorting price action and so forth, you know, on the day-to-day stuff. But look, you know, I think, you know, we haven't, you know, the VIX came through a period through some extraordinary events of COVID and then the Ukraine shock and then the most aggressive hiking cycle. And it's really been, you know, interestingly kind of leading the way down. One of the fascinating things I look at is the ratio of bond volatility to equity volatility. And I think one of the things that I'm looking forward into next year really is rate volatility to really come down. And that's going to be, I think, a very constructive force to keep risk appetite strong. Next year.
You're definitely speaking, I think, everyone's language, looking at the move versus the VIX. And it's been interesting. I mean, the conversation for a lot of this year was how do we see those two lines come back together? It seems as if the move is converging with the VIX has been the trend for at least a few months now. If we see the move come in further, of course, that measure of bond volatility, I mean, you talk about 10 on the VIX. Is single digits, does that enter the conversation at all?
Look, I mean, if you remember 2017, we had 9-handle VIXs. I don't think, I wouldn't say that. I think there's always a lot of anxiety points here, and I think we are getting overcooked here on this melt up, just from a valuation point of view. I'm actually very constructive on the broader outlook for next year. But yeah, no, I mean, generally, VIXs at those levels are not sustainable, hence my long VIX disposition there. But I think one thing I want to make point out on rate volatility is that, you know, people think about the move index being jacked up because of this record hiking cycle. Sure, yeah, the velocity of hikes was amazing, and coming from a very dovish place to arguably one of the most hawkish places in the Fed's history, that transition was created bond volatility. But you had that subsiding last summer just as term premium related volatility was coming in, and I think both of those factors are, obviously the rate hiking is done, but now we have the term premium thing, which I still think is going to be higher, but the shock of that is going to subside.
Just quickly here, do you still expect the S&P to close next year at 4,900 as the high?
Yeah, no, I do. I mean, that doesn't sound much from here, right? But I look at it as 4,900 from my current fair value is more like 4,300, you know, there. So I think I sort of like to bench my fair value, future value relative to my current fair value estimate there. But I think there's actually, we'll see how the year goes, but I think you know, if some of the things happen, if AI starts kicking in a little bit and you see, you know, that kind of drive productivity gains, you could see well north of 4,900 here. I think Yardeni's out with a 5,500 year end or something like that.
Do you endorse that?
I don't, look, it's not nearly as crazy as it might sound. I think there's a real upside there. But, you know, but to get from here to 4,900, let alone above 5,000, you're going to probably have to travel down to something, you know, closer to what I think is fair value right now. But I think earnings are going to hold together between the Magnificent Seven, between nominal GDP supporting the everything else to a certain degree. And I think multiples have gone through a lot of their adjustment process to, this sort of higher, longer, back-end interest rate condition.
Michael Purvis of Taubachen, thank you so much. If you are just joining, we are seeing the end of a week end on a high note. The S&P up 0.2% to 4782. Katie, you were saying earlier, it's the path of how you get there. And that's what we just heard from Michael Purvis, just the same way we heard from Julian Emanuel.
Of course, and you think about, Emanuel's prediction there that, okay, maybe it's a rocky first half, but you think about where we'll be sitting a year from now, it seems like most of the consensus says it's going to be bullish.
Well, 5,500 on the S&P, I can only imagine what the market capitalization of Apple will be. I mean, it's what, 3.1 trillion now? It's like this country, it's like the size of France's market cap or something. I mean, it's stupid.
Well, it's stupid until you see what they're actually doing. I keep going back to this. If you have to upgrade your phone, or if you have a kid who broke their phone, and you have to go and you see all these people lining up for the privilege of paying $3,000 for just various devices around the house to replace them. I mean, it just gives you a sense of how much cash they're actually generating.
Yeah, and that's why these conversations around quality. You want to pay attention to the quality factor. You want to take a look at dividend growers and dividend stocks there. Or you could take a look at Apple and the incredible product moat that it has, all of the cash that it's sitting on, and really consistent.
It's a safe haven. It's got safe haven qualities to it.
Exactly.
No, I mean, I consider it to be a safe haven in my portfolio. I like to buy Apple as ballast for the rest of my portfolio.
That's
sure,
your bond.
Sure, that's my fixed income allocation.
Well, it's probably your money market allocation, considering that all of its cash is currently in money market funds, earning 5%. Coming up at 8:30 a.m., Greg Dako, chief economist at EY, talking about the likelihood of a soft landing into bed for the weekend and into a year with an uptick to the markets. Right now, that uptick continuing with a bid into bonds, with a bid into stocks.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
I don't think we'll see demand peaking in our lifetimes, particularly as EM demand growth continues to surprise the upside. Let's not forget that the marginal cost of oil is going up, and that typically is the early leading indicator of an upcycle. It's just a matter of time before the market significantly tightens, and as the market tightens, we expect the second half of the decade will see severe tightening. That is the point where the only real quantum of volume that we can rely on and lean into is OPEC.
Christian Malik, global head of energy strategy at JP Morgan Securities, talking with a pretty nuanced brush about what to expect next year, especially given the surprise declines in oil prices that we've seen this year. This is Bloomberg Surveillance. Katie Greifeld, Damian Sassower, John and Tom both off. I'm looking right now at a Bloomberg Commodities Index that's down about almost 7% from mid-October. We're looking at oil prices, crude traded on the NYMEX, down from a high in September, a recent high of $93.68, down to $72.09 currently over in Brent crude. If you take a look over there, you are seeing similar types of declines currently trading right now at $77.20. That lift continues in the S&P. I do wonder how much some of the rally that we have seen in bonds, in stocks, is underpinned by disinflation hopes fueled by lower energy prices. This can reverse pretty easily.
Yeah, absolutely. Well, look, terms of trade really haven't had all that much of an impact, certainly on currency movement and certainly on my markets, the emerging markets. And that's kind of unusual, right? Because if you look out over the whole of history, it's been the macro, it's been commodity prices, it's been oil, it's been copper that's driven valuations in many of these markets. And you just really haven't seen that in the last few years.
What I find interesting about this leg lower that we've seen building in oil in particular is what it means for energy equities, because that had really been the leader in stock markets last year and the year before. Last year, up 59% for the sector. It's down on the year. It's one of your biggest losers in the stock market. So when you think about the ripple effects here, it's really showing up in the equity market as well.
It's also showing up in the airline stocks when you take a look at how much of a boom they've gotten, given the fact that that's one of their biggest input costs. To understand the trajectory forward, Will Kennedy joining us, I'm really glad to say, Bloomberg Senior Editor, Executive Editor for Energy and Commodities. Will, how much has this underpinned the disinflation, this idea that for whatever reason, commodity prices are going down, even though demand isn't falling off a cliff?
Yeah, it's been quite a trend, and as you say, Lisa, quite a surprising trend that we've seen the oil prices come off, and clearly many policymakers will have been delighted to see it. I mean, it's been a huge focus of the Biden administration, and they will be very comfortable to see oil prices back down where they are today. I mean, the question really is what happens next, and I think there's a certain amount of disagreement there.
Well, I haven't really read through the IEA's expectations for oil demand in 2024, but obviously it's lower in terms of, well, it's 50% lower in terms of growth, so 1.1 million barrels a day growth next year versus 2.3 today. What's driving the downshift in growth? What regions? Is this China?
Yeah, it is a China story, because the very strong number, and over 2 million barrels a day, is a very, very strong annual growth, is really driven by the fact that China was the last major market to emerge from COVID lockdowns, and there was a real spring back that juiced oil demand more than you would typically expect. The 1.1 million barrels a day that we're going to see next year, according to the IEA, is by historical standards a very, very healthy number. And interestingly, although they were pretty downbeat on oil demand in the current period, in the last quarter of this year, they slightly revised up their expectations for demand growth next year, showing that, despite all the economic uncertainties, demand does remain fairly strong.
So, Will, take me through this. Production cuts will see OPEC Plus's share of global oil supply fall to its lowest since OPEC Plus was first, created like 7 years ago. Yet I'm seeing pictures of, bro handshakes between, Putin and MBS. Talk to me about Saudi Arabia's Vision 2030 initiative. I mean, can they afford these production cuts? I mean, how long can they last, and will they try to increase production in lieu of the current state of oil prices?
We spoke with the Saudi energy minister a couple of weeks ago, and he was very firm in his belief that the action they took at the last OPEC meeting will be enough to rebalance the markets, that they'd looked long and hard at what the surplus looked like in the first part of this year, and that the cuts that they're going to deliver, the additional cuts they're going to deliver, will bring a market back into balance. Moreover, he signals willingness to keep cuts in place beyond the first quarter if they need it. Now, you make an important point, however, which is they are losing market share. And one of the most interesting things about the oil market this year, which has surprised people, is the strength of supply growth from America, from the shale industry. The shale industry has shown itself to be remarkably resilient. And when people expected it to slow, it hasn't slowed as much as possible. Whether they can sustain that next year will be fascinating to see. It's always the most important, one of the most important things to look at when you understand the oil market. And clearly there's a risk for OPEC there, is that you get into a vicious cycle where you reduce production to keep prices high, and those high prices could encourage more production from shale. So you keep stepping back on market share, and that's something that happened almost 10 years ago, where ultimately OPEC had to open the taps. Now, I don't think, talking to Saudi Arabia, they want to do that again at this stage, but there is clearly that danger. But their hope is these cuts and the additional cuts will be enough to bring the market back into balance and see prices rise.
And Will, I want to get a little bit existential here and really zoom out because, of course, we're coming out of the COP28 summit. Of course, one of the big news pieces from that summit was the first UN deal to really ditch fossil fuels forged at this summit. What are people in the market, what are oil executives, et cetera, thinking about long-term what demand for oil looks like?
Yeah, I mean, it was a historic agreement, and there are lots of people who are cynical about COP, but it does signal a bit of a direction of travel. It does signal that you have every country in the world signing a document saying that the world economy needs to transition away from fossil fuels. That's a pretty remarkable thing. But it is quite long-term in nature, and it won't happen overnight. I think one of the other significant things, though, was that there was a mention of transition fuels, which I think is a code word for gas. And I think the oil and gas industry is thinking, yes, EVs mean that oil demand will peak at some point. People argue about how soon that's coming, but let's say, for the example, by the end of this decade, oil demand may have peaked. I don't think people think that gas demand is going to peak. The gas industry was very present at COP. The gas industry presents itself as a way to get coal out of the system and replace it with gas, which emits less carbon dioxide. So that side of the industry is quite bullish. So I think one of the things that underpins is this trend that we've seen for some time, which is the oil and gas industry to be more gassy.
Well, Will, just sitting on this thought a little bit longer, so point taken that when you think about the demand side, this is something that's going to probably take place over decades, if at all. But talk to us about where supply could actually come from. It's interesting, you think about the U.S. involvement in this deal, and you think about the fact that U.S. production has really surged. I mean, how long-term do you think that that U.S. push to increase production will last?
Well, shale always tends to supplies on the upside, but I think most people think that shale will not grow forever, that the growth rates that we see in the future will be slower than those in the past. Clearly, the financial structure of the shale industry has changed a bit, with less emphasis on production growth and more emphasis on actually making money, and I think that trend will continue. And if we look more broadly, Christian Malik at the start of this conversation made a very important point. People aren't investing as much in new production as they used to. There is going to be a crunch point down the line if that trend continues. And I think one of the things to say about COP is it sends a signal that maybe investing in the long-term projects that oil requires, sort of 10, 20-year returns, billions of dollars, you're going to be reluctant to do that if this transition is going to happen. So one of the important things about this COP28 deal is it's likely to keep investment in new oil fields suppressed below historical level, which does mean that we could see markets get tight.
Will Kennedy, thank you so much for being with us at a time where oil has been some of the most counterintuitive areas of the market, just everything in the complex. I want to bring this to you from Neil Dutta, who came on the show yesterday, who's been bullish and has been right. And he said, yesterday we had the 4th highest percent of overbought readings in the SPX since 1990s. Since 1990. Guess what? This overbought is historically bullish.
Huh. A lot of people might take that as a contrarian, but you think about one of the ultimate contrarians, and it's Neil Dutta.
Well, Neil's been right, so we have to listen to him, right?
Well, you can do what you want to do, but what it basically shows is you can come up with all these indicators, but ultimately they mean something different to other people. Some people say, well, it's a sign to sell. Other people say, keep on buying. Coming up, Greg Dako of EY. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Coming up, we have some exciting things. Welcome back. This is Bloomberg Surveillance. We are seeing a bit of a lift in market after a really massive week of gains, particularly for the small caps, particularly for the bank stocks. Just taking a look at the Russell 2000, up almost 0.4%. That's down from earlier, about 0.8%. But those shares up more than 5% on the week. If you look at the KBW index of bank stocks, those shares are up by more than 9% at this point, if you take a look at futures on the week. Honestly, it's just a real melt up. And Katie, that's what we heard. It's basically, why fight it if there's no reason for anyone to sell?
Let go, let God, just accept that we are looking at a pretty booming equity rally right now. Of course, tepid gains at the moment, but you think about on a weekly basis, this is the 7th straight week of gains, which is pretty astonishing. That's the longest streak in quite a number of years.
And the 7th straight day of gains as well. So I don't remember the last time we've seen 7 straight equity market up days in a row. It's been quite a while, I think.
It's quite a number, 7 on many levels, where it's also been fueled by the bond market, the yields going lower pretty substantially, particularly in the 2-year space, 4.4%, though marginally up now. The 10-year space getting as low as 3.9%, now 3.91%. Honestly, these moves just massive. And you brought up a really good question, Damien, earlier, which is, what does that do to the structure of a market that is not built for whipsaw action like this?
Well, the question I have is, what part of the curve do you want to look at here, right? What's going to give you the most information? Is it 2s, 10s? Is it 3-month, 10-year? Is it 2-year, 30-year? Like, everyone's talking about a normalization of the yield curve, a steeper U.S. yield curve. But at which point, at which tenor points? I mean, that's where I kind of dig in my heels.
Yeah, what's going to drive that? I would imagine that's one of the big trades to talk about in 2024. What happens to that yield curve, and in what way does it normalize? Is it that bull steepener? Do you see 2-year yields really drive this? For a while, it looked like it was just the 10-year going up that could get us back to positive, but it feels like a long time ago.
Or do you just outright short 2 years, 2-year yields like Earl Davis? Meanwhile, you do see the euro lower just a bit versus the dollar as people take a look at some weaker than expected economic data out of the region. 109.42. Under surveillance this morning, China ramping up stimulus to support the ailing property sector. The country's central bank handing out $112 billion in 1-year loans to commercial lenders. Beijing and Shanghai also relaxing home buying restrictions to ease the housing downturn. The news coming as concern mounts, and it has been mounting, for the world's 2nd largest economy. Meanwhile, Treasury Secretary Janet Yellen announcing that she is planning yet another visit to China in 2024. Damien, I know this is your bailiwick. How much is the promise of stimulus really outstripping what China can actually deliver?
Well, it's outstripping for sure. I mean, there was an unconfirmed report overnight also that China is going to actually allow its budget deficit to expand to as much as 3% of GDP. I mean, that's got the markets fired up as well. So, you know, certainly all investors, myself included, are just looking and hoping and waiting for stimulus out of the PBOC. And if we start to see a lot more of that, yeah, I mean, things could really ramp up look, 5,500 in the S&P, I don't know, but you could definitely see a risk-on mood.
So that's what's going on over in China. Over in the U.S., the Senate delaying its holiday break as aid for Ukraine hangs in the balance. Majority Leader Chuck Schumer saying negotiations will continue in hopes they can pass a bill next week. House Speaker Mike Johnson has repeatedly said Ukraine aid cannot pass without a deal on immigration. The House has already left Washington for its holiday break. And Katie, honestly, to me, this is one of the most undertold stories of the past month. People have been so focused on Israel-Hamas that they haven't been focusing as much on the Ukrainian war and what's going on with the fact that if they don't get funding, is that essentially handing the victory to Russia.
Especially, too, when you layer on the fact what's going on in the EU, of course, not being able to produce some aid package there. It's interesting, though, to see this playing out in Congress. I mean, when it comes to the Democratic side, President Joe Biden, he has offered some compromises on U.S. border policy, but you think about how dug in these two sides are, what the eventual compromise will look like, hopefully being hammered out in January. It's going to be interesting.
Well, I'll say what's also interesting is the House is left for the holidays, but the Senate is still there, right? I mean, so it's interesting that Chuck Schumer's kept them back, and they're trying to get things planned for the beginning of January.
Let's see when they decide to actually throw down the gauntlet with the House. Meanwhile, this is the story that we actually wanted to get to. I'm sure you both have thoughts. Apollo and Blackstone getting into the holiday spirit with their annual videos. Oh my. Apollo's features Chief Economist Torsten Slok dressed as an elf. Meanwhile, Blackstone going all in on its fandom of Taylor Swift. Senior staff lip-syncing about the firm's, quote, alternatives era. CEO Steve Schwartzman even wearing a shimmery jacket similar to the one Swift wore to sing Karma. Thoughts? Who wants to start?
I have two thoughts. I'll start with Apollo. I think Torsten Slok has to be the tallest elf there ever was. I don't know if that was quite believable. And then on the Blackstone...
That's the only thing that was really a problem.
That was the only thing I'll say there. On the Blackstone video, I know a lot of people did not like this. I saw a lot of snarky tweets, to put it mildly. I didn't hate it.
I didn't hate it, but I mean, John Gray in the mosh pit, you're right. Schwartzman with the sequins and the whole jacket. I mean, for guys who are managing that much money, to see them having so much fun and talking about Taylor Swift concerts, it kind of,
Should they not have fun?
That's
no,
exactly
I know.
what
They're
I was
not supposed
gonna
to be fun. They're supposed to make us money, right?
No,
exactly.
well, I mean, this is the whole like Instagram era and TikTok era. If you're going to do marketing, who do you want to get? You want to get the Taylor Swift fans, and you want to get in.
Although I appreciated seeing that other side of them. I mean, they're always so serious every time John Gray and I go out for drinks. I mean, it's nice to see him let down his guard a little bit.
You trying to basically come back after basically saying no, what are you guys doing? Honestly, we're talking about it, and that's probably the point. So I guess a win on that front. It worked, exactly. If they're looking for publicity. Right now, what we are looking for is just some sign in the data of confirmation of the disinflation narrative. It felt like a very hard pivot there. I do want to bring you this. We did just get Empire Manufacturing moments ago, coming in way below expectations, declining 14.5% versus the expectation of increasing about 2%. The prior reading was 9.1. So just a sense that we are seeing some sort of slowdown. Joining us around the table, Greg Dacko, chief economist at EY. Do you think that hopes and dreams of immaculate disinflation have gotten overblown, and that there is this concern about a slowdown that's deeper than people are pricing in?
Well, I think we have to be nuanced when we analyze the economic landscape. We are in an environment where we are seeing slower economic activity. I think there's no denying that. Whether it's on the consumer side or on the business side, we have seen a slowdown in terms of the pace of growth. So it's not immaculate disinflation. We've seen the supply come back online. That's helped with the inflationary picture. And we're seeing moderating demand, which is also putting downward pressure on inflation. So it's not immaculate. And I think as we look into next year, that's going to be continuing to drive inflation lower, whether it's rent disinflation, slower momentum in terms of growth activity, even wage growth compression, and the fact, let's not forget, that the Fed is still maintaining a restrictive monetary policy stance. Combine all of those, and you have all the right ingredients for a disinflationary environment.
Let's talk about sentiment a little bit, because we've been talking about this morning the fact that you think about the U.S. consumer and you take a look at these sentiment surveys, and it has just been grim out there for years now. And when you think about inflation, yes, we're in this disinflationary environment, but the outright level of prices is still much higher than it was. Do we need to see actual deflation to see some of those sentiment numbers pick up?
I think you're alluding to the most important point when it comes to the inflationary dynamics, because we talk about inflation. Economists, policymakers, we all talk about inflation. But what matters for the average person, whether it's the consumer or the business leader, is the cost level. The cost fatigue phenomenon is very real. The cost of everything is much higher than it was pre-pandemic, whether it's goods, services, labor, inventory, even interest rates. Everything is much higher, costs much more. That is leading to business decisions being pulled back and being more scrutinous about how much to invest. It's leading consumers to be more careful about how many goods, how many services they buy, even though they're spending a little bit less. And I think that's the very important narrative that's going to be really underlying the pace of growth next year, is how sensitive people are to this higher cost of everything environment, and how the labor market reacts. Let's not forget, the labor market is the key pillar to economic activity.
Greg, the dot plot's calling for 75 bips of cuts. I think the market's priced in 140 bips of cuts. It's a pretty big divergence there. You know, talk to me about the why. Is disinflation enough of a reason for the Fed to cut rates in 2024?
Well, yeah, I think the key reason why the Fed will be adjusting rates is because it sees less inflation. Last time I was on the show, I was talking about the fact that we have the holy grail of non-inflationary growth in front of us. We have an economy that's still moving forward, but inflation that is moderating. That is what the Fed wants. The Fed does not want a recession. It wants to see inflation come back down to 2% and become a non-issue, a non-topic, something that we don't talk about every day on this show or on other platforms. This is really what the Fed is aiming for. So whether it comes to the Fed's forecast being realized or the market expectations being realized, I think the truth in the end will lie somewhere in between. Probably 100 and 125 basis points of rate cuts by the end of next year, with an environment where inflation is gradually slowing and we don't enter recession. If we enter a recession, the picture in the game is going to be quite different.
Greg, off the air, Lisa and I always like to talk about real yield. She likes the 5-year. I like the 10-year personally. 10-year real yield, 1.88%, down 60 basis points since October. How low can real yields go?
Well, I think that's the key question for next year is going to be what happens in terms of growth momentum, what happens in terms of inflation momentum, and how rapidly does the Fed ease monetary policy. That is what Fed Chair Powell and the rest of the Fed officials are going to be focused on. They're going to be focused on ensuring that real yields don't rise. They do not want to be tightening in the face of a slowdown in final demand, in the face of a slowdown in inflation. So they're going to be recalibrating monetary policy gradually. I think the March rate cut calls right now are a bit extreme. They're going to be making sure that inflation is really sustainably on this trajectory of lower inflation, and then recalibrate to the downside gradually with 25 basis point increments to start with.
Meanwhile, I do want to just bring this to you. New York Fed Chair John Williams has been speaking, and he said that the market is reacting maybe more strongly than forecasts show, and also said we aren't really talking about rate cuts right now, as Neil Dutta over at Renaissance just commented. Sorry, but you can't put that toothpaste back in the tube. There is, however, a market response. We are seeing bond yields rise, 2-year yields rising to about 4.46%, 10-year yields spiking upward to about 3.96%. This raises a question, Greg. Do you think that they are getting concerned about the easing in financial conditions beyond what Jay Powell seemed to indicate yesterday?
I think when people say that the easing of financial conditions is going to reignite growth and reignite inflationary pressures, I tend to be a little bit more cautious. First of all, as we were just talking, we have to factor in the fact that maybe market expectations are a bit too strong. Fed policy communication is going to recalibrate that market perspective. Number two, let's not forget, as we just talked about, cost fatigue and labor market developments are going to be the key drivers of economic activity, not so much rates. And then number three, and this is very important, we are in an environment where there is less rate sensitivity. There was much less rate sensitivity on the upside. We should expect to be a little bit less rate sensitivity on the downside as well. All three factors mean that we have to be a little bit more nuanced when it comes to the economic picture.
Greg Dacko, wonderful as always to catch up with you. Happy holidays.
Always a pleasure. Happy holidays.
Greg Dacko of EY. If you are just joining right now, you can see the S&P has actually turned negative on the heels of these comments, down about 0.1%. 10-year yields markedly higher, about 5 basis points higher, 3.97%. We do have to pick up there, this idea that John Williams, the president of the New York Fed, coming out saying we aren't really talking about rate cuts right now. The knee-jerk reaction is to just reverse, Katie, what we saw over the past couple of days.
I think we should all feel very vindicated, because we were talking about this about an hour ago, that now the either the fine-tuning, the pushback, or the endorsement starts to see John Williams come out and say, we aren't really talking about it. We have the receipts. We know that Jerome Powell said on Wednesday that the Fed not only talked about it, but they discussed the timing of rate cuts at the meeting this week. So it's interesting.
After a weak Empire survey too, huh?
Yeah.
So it's kind of convenient. No, I'm just kidding. but seriously, I mean, like, if you really believe that, you know, I mean, that he needs to walk this back a little bit, which everybody does. I mean, the one thing you can't walk back are financial conditions here in the U.S. And, you know, the fact that the Fed has come and explicitly said that they are watching that means that they are watching everything from spreads to equities to the dollar. And so it's not just inflation and growth anymore. It's a lot more than that.
And you can see that it's a pretty direct knee-jerk reaction. Just taking a look at Fed funds futures, right now they're pricing in about a 72% chance of a Fed rate cut in March. So still solidly pricing that in. Yesterday, about the same, but we saw that kind of idea of a knee-jerk reaction get that up to close to 9% at one point. Wow. So, I mean, 90%, excuse me. Coming up on the open, Keith Lerner of Truist, Marilyn Watson of BlackRock, and Max Kettner of HSBC, as everyone frantically rewrites their year-ahead outlooks, or maybe not. Maybe they just say it's just a matter of timing and it's going to be bumpy and we can expect another year like the one we've been having. That's coming up next.
The reception, the acceptance of Purosangho has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosangho all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Chair Powell put the rate cuts on the table because he wanted the markets to start to lower these long-term real interest rates. And it gives him time to slowly adjust the Fed funds rate, probably wait until spring or summer before actually starting the implementation of the stuff, of the rate cuts. And that way, I think he can smoothly navigate that real rate down.
All right, that was Bill Lee. He is chief economist over at the Milken Institute, talking to us just a little bit earlier on Bloomberg Surveillance with Tom Keene, John Farrow, and Lisa Abramowitz. Tom and John, they're off this week. Lisa is on her way to the Open, so it's just you and me.
It's just you and me. Yeah. No, isn't that how it should be, right? Talking about the pass-through from U.S. Treasuries into broader risk markets, talking about equities, commodities, everything was ramping just until a few minutes ago.
Just until a few minutes ago. And let's talk about why things changed. Of course, we are hearing from the Fed's John Williams coming out with some comments on the heels of hearing from his boss 2 days ago, saying that Williams, we aren't really talking about rate cuts and that it would be premature to be thinking about a March rate cut. A lot of interesting things there because we heard something a little bit different from Jerome Powell just 2 days ago.
Well, we should be patting ourselves on the back because at the beginning of the hour, we were talking about, we're not even thinking about, hopefully thinking about rate cuts. And here comes John Williams to the rescue saying exactly that. So
yeah.
I think we had to walk some of these things back. I mean, the markets were just getting far too bit ahead of themselves here.
Yeah, and we're definitely going to spend some time on these comments in our conversation coming up. But taking a quick look at the market right now, you take a look at S&P 500 futures turning a hair negative, nothing too dramatic there. You take a look at the euro dollar, also down on the day. 10-year yields reversing a little bit here, up about 3 basis points, but still we're talking about very, very low levels here, Damien.
Yeah, no, very low levels. But I think, look, at the end of the day, this is more than just a rate story. It's about currencies as well, right? I mean, there was a big move against the dollar for the better part of the last few weeks, and now we're starting to see that reverse as well. And so if we do indeed see a little bit of compression between Europe and the U.S., we're going to see euro dollar come off here.
I never forget the currency market, but I can rest assured that you will never let me forget
No, I'll never forget. Yeah, exactly.
You're all about it. Let's get to some of the individual movers, though, in the pre-market session. There's a few interesting ones here. I wanted to start with General Motors, GM there. You can see not too much of a move right now. This stock has been interesting, though, because, of course, the news this week, GM to cut more than 1,300 jobs at 2 plants in Michigan. It's been a really interesting, a really tough time for the automakers recently.
Well, yeah, and obviously, you know, the Cruise, I forget the name, their autonomous driving,
Cruise, yeah.
right? I mean, they've invested, what, almost $750 million in it in the last quarter alone, and now they're talking about layoffs. And I think they expected to see something in the order of $1 billion in revenue by 2025, and good luck seeing that. I think $50 billion by 2030. I mean, those are huge, huge numbers. For them to be having layoffs now tells you a little bit about what's going on there.
And you think about the big three still dealing with the impact, the fallout from those 6-week-long strikes.
Sure.
Definitely one to watch. Let's move on here, though, to some of the other movers as well. We do have Lennar. This is an earnings story. This home builder, it reported yesterday after the bell. It's declining right now. Weaker gross margin. The forecast was disappointing as well. You can see shares currently off by about 3.6% right now. Home builders, when you think about what's going on in the housing market, just the total freeze there, for a while it was benefiting to home builders, but now the story's changed a little bit.
Well, home builders have absolutely ripped in the last few weeks, right? So it's understandable to see a little bit of a pullback here, but you know, in terms of rate-sensitive equity sectors, I mean, the home builders are probably number one, right? So if you really do believe that, you know, hey, I mean, we're going to test the lower end of the 3% handle in 10 years, you know, the home builders should be a pretty good play there, Katie.
I know that mortgage rates slipped below 7%, but we're still talking about 7%.
Yeah, it's still high. It's still so high. Yeah, somebody who was very close to me who knows the market really well said 5.5% is the magic number.
That's when we start to see some movement?
It should be when, you know, you're going to start to see things shake up and supply sort of come online.
All right, so we'll keep receipts on that one. But just quickly, let's also talk about Roku here. Not having a great morning, down about 3%. This coming on the heels of a downgrade to sell from neutral. That's at MoffettNathanson. Analysts there saying that basically the company was getting more focused on efficiency and margin expansion, but at over $100 per share now, Roku's share price has nearly doubled since then. So really a victim of its own success, at least in the equity market behind that downgrade. But let's get back to what we're seeing in the bond market, in the equity market right now, driven by these comments from John Williams. Let's welcome in Megan Swiber. She is Director of U.S. Rate Strategy over at Bank of America. And this feels how it usually goes. Of course, you have Jerome Powell come out at these Fed meetings, and then Fed speak happens and tend to walk it back.
Yeah, I think that's exactly right, Katie. We had just such a prominent rates market response to Powell's very dovish comments here. And so we were actually flagging some of this in our recent publication. It seems like the market's in for a bit of a consolidation here. And I think that Williams' comments really endorse that. One of the things, though, that we see borne out in a lot of the indicators that we look at, though, is we had positioning largely long coming into some of these moves that we got. So in rates in particular, that's an area where we can see investors covering profit taking alongside some of these recent moves as well.
Well, I mean, Katie says that I never like to not talk about currencies. So I'm going to talk about currencies here because you talk about currencies. We're talking about dollar yen here. I mean, that's one of your trades, right? You do believe that there's more downside to dollar yen at current levels, but I look at rate differentials and I say, wow, look at those rate differentials. To put that trade on, my goodness, you're going to be bleeding on a P&L basis. How do you put that type of trade on? How do you play that in the market?
So this is actually something that we're seeing a lot in the FX and rate sentiment survey that we conduct at B of A. Generally, investors are short dollar, and the way that they're kind of playing this, of course, is against the yen. And we think that that positioning is really quite stretched right now. So ahead of some of these adjustments that we see coming from the BOJ, we think that the preferred way to do this is in short JGBs rather than to play this in the currency market because of some of that stretched positioning that we see.
No, I don't disagree. But then you also have, I mean, look, if forget about dollar yen, you've got Mex peso yen, right? I mean, look at Mex peso. It's one of the few currencies that's really been kind of off relative to the whole of every other currency with the dollar, because it kind of tracks the dollar. Talk to us about that dynamic, the fact that, you've got currencies like the Mexican peso that tend to track the dollar in certain environments, currencies like the Japanese yen that tend to track the dollar in risk-off environments. How do you kind of manage through that when you're a fixed income investor?
So I think that what the real impetus that we see for a lot of this divergence in positioning is just that conviction about the Fed path, which is actually another thing that we see borne out in the survey, is that investors are long rates and short dollar, but ultimately alongside that there is some skepticism around how much is the Fed ultimately going to cut. Investors generally thinking that if there's one central bank that can surprise a little bit more so to the hawkish side versus expectations, it could indeed be the Fed. And I think that it really comes down to this message that they've been delivering, which is data dependence. The market understands their reaction function now, that they want to be cutting alongside this progress in PCE inflation. And so that's why we've gotten this such sharp recalibration. But the Fed has really done such a heel turn on this that there's risk that they can do that again.
Well, let's talk about the dispersion of potential outcomes here, because you have the dot plot penciling in, 75 basis points of cuts next year. Then you have the market at 150 basis points. Where do you fall in between that?
So we've been long coming into this, this most recent rate rally. I want to say the year because we wrote our year aheads in November, but it really has been almost a year in a month in terms of some of this price action. So we had been recommending investors trade long the 5-year sector in particular, because that's the point in the curve that can not just be sensitive to just what the timing is of cuts near term, but also this trough of the Fed cutting cycle. So when we look at market pricing versus the dot plot, what we see is the market is certainly overpricing the extent of cuts versus what the Fed has endorsed. But what we see also on the flip side is that the market's pricing a higher trough of the neutral is. But the market's still very reluctant to price that. And I think it really is driven by some of the uncertainty that we still see in the inflation market. And the fact that we were not really seeing broad-based weakness elsewhere, and trying to get a better sense of what is it that's going to cause the Fed to really cut more aggressively and bring rates back down to something that they think is that neutral rate. So we've been long. We've taken that position largely off because of the very sharp performance that we've observed. And now we're being a little bit more tactical, managing some of the opportunities that we see headed into next year, but are roughly neutral at this point.
All right, Megan, great to check in with you, especially to get your live reaction to these comments from John Williams that are moving the markets right now. That is Megan Swiber of Bank of America. And Damien, I mean, we've been joking that not too much going on, but Fed speak, you can always rely on it.
Yeah, no, absolutely. And look, I mean, I think the real big question, I mean, we know that it's going to be the Fed and Treasuries, the pass-through into broader risk assets in 2024. That's still going to be the story. The question is, which direction do we go? Is it going to be a hard landing or a soft landing? Because the implications of that have so far-reaching across all asset classes, and that's really going to be the focus. Is it going to be a recession or not?
All right, well, the year is not over yet, and neither is the day. Coming up on Bloomberg TV at 2:30 p.m., we have Nicholas Bailey, President and CEO of RE/MAX Holdings, on his outlook for the housing market in 2024. Thank you for tuning in. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. A little bit of a softness after hearing from John Williams pushing back, or trying to, of some of the enthusiasm from yesterday. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
The Fed-fueled rally continuing, or maybe on Wall Street. Stocks heading for a 7th week of gains as the ECB pushes back against the Powell pivot. We begin with the big issue. Santa comes early to Wall Street.
Santa did come early this year.
Yesterday felt like Santa Claus came to town a little bit.
Santa Claus rally.
Santa rally. What Chair Powell gave us was probably an early Christmas gift.
We got an early holiday present.
Obviously, we had a bit of a pivot. The idea that the Fed is done raising rates for now.
We're finally done with rate hikes.
We were very surprised by the dovish tone that Powell struck. He was very dovish in his messaging.
Declaring somewhat of a victory lap because inflation is moving down towards their target.
This was the first time that he really gave a nod to the trajectory of inflation and the fact that it is easing.
We've clearly seen the reaction in markets.
A rally across risk assets.
Rally in the bond market.
There's an everything rally going on right now.
Quite a rally.
We have some room for risk to continue to rally.
We're entering next year, I think, with a growing sense of optimism.
Joining us now to discuss is BlackRock's Marilyn Watson and Max Kettner of HSBC. Of course, we do have a little bit of a softness, basically range-bound, after John Williams tried to push back against this by saying that maybe counting in a March rate cut was premature. But Marilyn, I want to start with you. Are you leaning into the Fed pivot, or are you trying to step back?
So I think Powell and the FOMC were very, very clear that they've essentially probably come to the end of the rate hiking cycle, and that next year, we can expect to see rate cuts at some point. I think given the data in the US, overall the economy remains still robust. It's still on a very good footing. We are seeing inflation come down, and the Fed certainly acknowledged that. They acknowledged that they are pleased with the progress that they've seen in inflation. There is more to do, but I think certainly the FOMC did put across a very clear message that they have achieved many of the things that they expected, and they are continuing to see inflation come down.
So it really raises this question, do you lean in or do you start to say, well, the economic data has not been completely, fully delivered yet? Max, from your vantage point, the rally that you've been talking about for so long has transpired. Do you start to get a little bit nervous that we're getting toppy?
Yeah, good morning. No, I'm not getting a little bit nervous. I'm getting very nervous because the problem for me is, and that is perhaps because of my nationality, I don't like to be liked. I don't like when people agree with our view. And the problem really in the last couple of weeks is that there's too many people talking about Goldilocks. So it was much more fun at the beginning of this year. It was much more fun over the spring and the summer to talk with clients about why we thought this was continued Goldilocks and what was arguing for that. And now when I mention the word Goldilocks, all I get in terms of reactions from clients is, well, yeah, fine, we fully buy into that. That is not good. Let's remember, one of the key ingredients of continued Goldilocks is that people continue to fight it, is that people always find some sort of stuff that can go wrong, right? Some downside factors that can derail that. Whereas all I'm hearing right now is everything's perfect, right? With the Fed pivot now, this is the green light, it can only go up from here. In terms of what we're seeing and in terms of our sentiment and positioning indicators, they now almost maxed out bullish. We're on the 95th percentile. It's the first sell signal, really the broad-based sell signals we have since the beginning of July. So to us, this is clearly an environment where we don't want to lean into this anymore.
Are you actually leaning against it, Max? Are you selling?
Yeah, I think you want to start to sell now, possibly not now, right? This is not the moment just now. I think it's for something for the start of the new year. I think it argues for a cautious start to the new year. Right now, the problem is, trading liquidity is too thin. We know that, right? There's not enough people around anymore. I'm going to be on holiday from Monday, so there is not too many people around anymore. What we're seeing is probably mostly driven really by systematic trading now, CTAs and vol target funds, and they aren't maxed out yet on their positioning, right? So we're probably going to continue to see more momentum now in the next 2-3 weeks. It argues, however, for a cautious start to the new year, and I would argue really for a cautious start to the new year across all the asset classes, because I do think that those equity bond or risk-on asset class correlations with bond markets are still going to remain very uncomfortably high.
And I will talk about your vacation plans in just a bit. But Marilyn, I'd love your thought on just exactly what he's saying, that essentially people have gotten too comfortable with Goldilocks. We were just hearing from Earl Davis over at BMO Global Capital Markets, and he was saying that he could see 10-year yields retesting 5% next year. Do you agree that basically this is going to be rocky?
So I certainly think we're going to continue to see elevated volatility as we've seen throughout this year. Partly because of positioning, partly because we have seen all of the major central banks step away, apart from the Bank of Japan, of course, from the incredibly loose monetary policy that they've had in the past few years, which has been suppressing volatility. So as we do see increased price dispersion, also as we do see more dispersion in economic data, whether it's between the US and Europe or elsewhere, I think we will continue to see more volatility. There are a range, of course, of risks out there that are ongoing, including the huge debt burden in the US and other factors as well. But we think if you can position yourselves for a quite high quality income-focused portfolio, then you can achieve very, very attractive carry, you can achieve good returns, and there's no need to actually take a huge amount of risk. There's no need to believe in a pure Goldilocks environment. And you can get attractive carry in the belly of the curve. You can add on that securitized assets, and you can add on investment grade in Europe and elsewhere where we find valuations. So I think it's about being sort of pragmatic and about really focusing on the areas where you can get very decent income or returns and not taking too much risk. And not taking too much risk if you do believe there's going to be volatility in a certain sector.
Just real quick here, Marilyn. There has been a huge bid to credit, though, and there have been yields coming in to the lowest levels that we've seen going back to early last year. If you look at investment grade, hasn't it gone too far?
So we have certainly seen a massive move in spreads and in all-in yields as well. But I think you can, when you look at the underlying, on a bottom-up perspective, you can still find decent valuations. You can see price dislocations. But I think it's about, again, about having a balanced portfolio. So looking at areas that are more attractive, such as Europe IG, particularly when you would then have the, if you're hedging it back into dollars. Also, if you look at certain areas of high yield, certain areas of emerging markets, it's not taking about huge amounts of risk. It's just taking it in, in areas where you do have a high conviction. But certainly when you look at spreads and when you look at the all-in level in IG, then it has come in a lot. So it pays to be a little bit cautious and just, again, really put the research in and put the time into really understanding the liquidity and understanding the risk reward from any position that you're putting on.
Meanwhile, U.S. markets are continuing to rally for the most part off the back of Powell's policy pivot. The S&P 500 closing higher every day this week and poised for a 7th week of gains. Joining us now, back for more fun, Bloomberg's Katie Greifeld. Haven't seen you in a while. Katie, what you got?
Well, we've been calling it a pivot party. Maybe we can call it a pivot rager because it has just been an extraordinary cross-asset rally. And even within the equity market, you can really see the rally broadening out. You're taking a look at the small cap index right now. And as you can see to the right of that chart, it has just been a straight line higher. And this is usually how it goes. I mean, you think about December, you take a look at the outperformance the Russell 2000 typically has against the S&P 500. This is going to plan. A lot of this is being fueled by what we're seeing in the bond market. You take a look at treasuries right now, your U.S. 10-year yield, we are below 4%. You think about where we were in October, in mid-October, we were just kissing 5%. So the fact that we're 1 full percentage point below that October peak is really breathtaking. And of course, that move has accelerated this week. We're below 4% right now. We entered the week closer to 4.20. But it's not just stocks and bonds. Let's also broaden this out to commodities as well. You think about the moves that we're seeing in Brent. It's been a good week for Brent, up by about 1.4%. This comes after a big leg lower for oil. Whether this is a trend breaker remains to be seen, but we can say definitively that this week has been a good one for the commodity complex as well. Not so much if you take a look at FX. If you take a look specifically at the dollar, the Bloomberg dollar index right there, actually that's the DXY rather, over the 4-month period, we're actually a little bit below, but you can see this move really started in October and it's picked up in recent weeks as conviction grows with the blessing of Jerome Powell himself that the Fed's next move is going to be a rate cut.
Katie, thank you so much. As always, there is this big question here about whether the U.S. is still the best place to invest at a time where the Fed is going to be potentially cutting first. Still with us, Marilyn Watson and Max Kettner. I want to go to you on this, Max. Do you feel like something is shifting and the rest of the world will get more of a bid as the U.S. gets perhaps more dovish than we're hearing from the ECB and the Bank of England?
Yeah, normally we would see that, right? So normally it would be quite bullish for things like the UK or Europe, right? So you'd be selling the dollar and buying all other sorts of currencies for the carry. But the problem this time around is actually, if we're defining Goldilocks as an environment where broadly you want to go long carry and long growth in equities, then if you look at G10 currencies, except for the New Zealand dollar, right? The dollar is actually the highest yielding currency. So I'm not fully buying into this, oh yeah, the dollar is going to go down another 10% or something. And, we're going to see euro dollar at 115, 120. But me, if we go euro dollar towards sort of 110, 112, cable perhaps going to 130, let's always remind ourselves any kind of repricing, such as we've seen over the last hour, driven by the Fed's comments or by Williams' comments. If we see a little bit of a repricing of those near-term rate expectations, then the one thing that works is the dollar. It will lead to a pretty broad-based sell-off yet again, such as we've seen, for example, in September, October, such as we've seen over the summer, or like in 2022. And the only asset class, the only asset that really works there is the dollar. So I would much rather, going into 2024, use that leg lower in the dollar to start putting on some hedges and buying some topside actually in the dollar and going the other way around.
Marilyn, what's your sense in terms of whether the dollar is kind of reaching an equilibrium at this point versus poised to weaken that much further if this divergence continues?
Yes, I mean, certainly when you look at the dollar versus other areas, such as if you look at the euro, for example, then we are actually seeing a diversion in terms of economic growth there. So I think it's hard to see the dollar weakening too much in the foreseeable future because the US economy continues to look like it's on a pretty decent, stable trajectory. So I think, if you take whether it's the UK, whether it's the Eurozone or elsewhere, then we are seeing this increased diversion between the economic performance of different regions. And I think overall, the US does look like it remains on a very stable footing. So it's hard to really see in, certainly in the near future, that the dollar would particularly weaken much from here.
Marilyn Watson, Max Kettner, both of you are sticking with us. Let's take a look now at the stocks moving ahead of the open. Abigail Doolittle here. Abby.
And beneath that relatively benign surface for the S&P 500, Lisa, we do have some bigger movers to talk about, starting off with the shares of Costco. This discount big box retailer reported a solid quarter. They beat profits. They also announced a special dividend of $15, the first one since 2020. They're talking about prices starting to moderate. Now, this is one retailer doing well in the year, up 38% into today. Intel up 2.2%. They've unveiled server and AI chips. The stock was raised to a neutral at B of A. Surprisingly, up 71% this year. Well, maybe it's not surprising given the rally, but that's the best year since 2003. I guess surprising relative to Intel. And then Lennar down 3.4%. They beat. And while the first quarter net delivery numbers were solid, Lisa, they are suspending their full year margin guide around rates uncertainty and other factors. Investors not liking that, sending that one down 4.1% in the pre-market.
Abby, thank you so much. I thought that was interesting, especially in light of some of the recent discounts that certain houses are being sold at. Coming up, hawkish pushback from the ECB.
Should we lower our guard? We ask ourselves that question. No, we should absolutely not lower our guard.
ECB President Christine Lagarde resisting the Powell pivot amid a deepening slowdown in Europe. That conversation coming up next.
The biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
The risks to economic growth remain tilted to the downside. Growth could be lower if the effects of monetary policy turn out stronger than expected. A weaker world economy or a further slowdown in global trade would also weigh on euro area growth. Should we lower our guard? We ask ourselves that question. No, we should absolutely not lower our guard.
Recession odds growing in Europe thanks to weak private sector activity. Euro area PMIs contracting for a 7th straight month in December. In the area's two biggest economies, France and Germany, hit particularly hard by the slump. Still, European central bankers are in no hurry to join Fed Chair Powell's pivot party, even as traders fuel rate cut bets and insist the ECB will have to ease a policy. Bloomberg's Maria Tadeo joining us now with more, and we are hearing from New York Fed President John Williams over here with a little bit of pushback, trying to walk back a little bit some of the more dovish tone from Jay Powell. Is there the same kind of feeling over in Europe?
Yes, and I thought that clip that you played was actually fantastic because it really shows the conundrum that the European Central Bank is facing, where you have the head of the European Central Bank who openly says the risks are tilted to the downside. By the way, she also said if monetary policies, meaning the transmission, the hikes they've done so far, and this is the most, or was at least the most aggressive hiking cycle to date from the European Central Bank, also proves perhaps too strong, that could impact the economy negatively. When you look at Friday morning today, we end the week with PMIs, as you say, that once again show this is an economy that cannot catch a breather. We're back to 47. Of course, that shows that the economy is now still in major contraction. But what is important about the numbers that we got today is that it shows perhaps that this theory that the European economy had bottomed out and could only grow from here may not be in fact manifesting. So there's still lower room to go. Again, the conundrum, to answer your question, from the European Central Bank is that facing all of that, they are still saying it is too early to cut. There are no internal debates going on at the European Central Bank to cut rates. In fact, she also continued to say the theme of higher for longer is one that the European Central Bank wants to spend time on because they want to reflect on the data. And this goes back to also some of the criticism from the European Central Bank, which, as you know, there are voices that say when you look at their forecast and you look at the data and the assessment that they make about the economy, they are perhaps a little bit too over-optimistic about the resilience of the economy and have not factored yet perhaps how fast inflation is falling down. So there is a risk now perhaps that this is an economy that is heading into a slowdown that is now markedly in those PMIs, and yet a central bank that insists we want to stay for the higher for longer theme as long as possible, and most importantly, as long as credible in the eyes of the markets, of course.
Wonderful work, Maria Tadeo. Thank you. What Maria was saying there really dovetails into the market reaction, which is we don't believe you. Marilyn Watson and Max Kettner are still with us. Marilyn, do you agree with the market? We don't believe you, ECB, that you're going to hold on for longer than the Fed and that you're not going to cut rates as soon as March.
Yes, I think that's right. And, as you just heard, the PMI data was very weak, particularly in Germany and France, where it's clearly in contractionary territory. It does seem most likely that the ECB will end up cutting rates before the Fed. Yesterday, I think, as Lagarde tried to strike a very balanced tone. And some of the ECB's forecasts as well, looking at inflation, for example, were perhaps slightly higher than a lot of people were expecting. Inflation is also on a trajectory that's coming down in the Eurozone. The economy is weakening. It was quite interesting today in the PMI data that we did see continued growth in output prices. That's perhaps more than expected. But overall, I think it's pretty, it seems pretty clear that the ECB is on, a less positive growth trajectory than the US, and it certainly seems that inflation is coming down, and it is most likely that the ECB will cut first.
And it does seem like people are coalescing around that idea. I'm looking at a 10-year German yield at around the lowest level going back to January at about 2%. Max, do you agree with that, that regardless of what the ECB says, they're going to hike first, they're going to have no other choice? I mean, cut first, excuse me.
Yeah, I think, look, I guess we've seen a few tweaks yesterday, right? We've seen, for example, in the statement that the ECB is saying that inflation is, or they've dropped the statement of that inflation is too high for too long, which perhaps is a bit more dovish, right? But of course, also Lagarde was saying, look, the first half in particular is going to be very rich in terms of the incoming data to watch. So all of that really suggests that perhaps, to us at least, yes, earlier cuts. We did anticipate cuts from the ECB only in December next year, and we've brought them about 6 months forward. So they're going to come from June in our view, and then once per quarter, but not as aggressive as the market is saying, right? I do believe that some of that market pricing, both with regard to the ECB, but also with regard to the Fed, is really a little bit too much, is a little bit too overdone. And there is a risk, right, that in particular, given that we have these really low growth expectations still, both for the US and now certainly also for the Eurozone, right, where consensus growth expectations are much, much lower, that some of those data, most likely more in the US, is going to surprise a little bit to the upside, right? And that will bring perhaps some of that dovish rate pricing out of the market a bit.
So Max, just quickly here, because you were talking about how you would lean against some of the enthusiasm. Where? In Europe? Because you are seeing the CAC and the DAX both at record highs.
Yeah, look, it's a broad-based thing, right? Like, let's be honest. If we had bought anything between the September FOMC meeting and the November FOMC meeting, there was losses across the board, except for gold. And the reverse happened in the last month and a half. So frankly, I think, you know, in a world where correlations are still very close to one, which I don't see changing anytime soon, right? And you have a range of outcomes, really, and a range of potential hedges. But on the downside, the only thing that tends to work, if you have a broad-based sell-off across rates, credit, right, and EM and equities, the only thing that tends to work is the dollar. So it's not really something where I'm saying, oh, I want to go short particular sectors or something. No, it's particularly really putting a bit of topside on the dollar, right, buying a bit of topside on the dollar, particularly versus sterling here, because it's a relatively clean risk-on currency against any kind of potential declines, not massive, right? But 5 to 10% in equities at the beginning of the year. Yeah, why not, right? And for that, really a bit more, a bit higher in the dollar and a bit lower in some of those risk-on currencies.
Marilyn Watson, Max Kettner, both of you, thank you so much for being with us on a reset moment after a pretty massive week. Coming up, the morning calls, and later, stocks heading for their longest winning streak since 2017. That conversation still ahead with Keith Lerner of Truist. You are seeing a bit of a range-bound market as we end out a pretty big week.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for our morning calls. A look at some of the analyst recommendations this morning. First up, Wells Fargo upgrading GE to overweight, highlighting the company's clean balance sheet and best-in-class management. Next up, Bank of America upgrading Clorox to neutral, expecting shares to benefit from a challenging macro environment. And finally, MoffettNathanson downgrading Roku to sell, seeing a stretched valuation and mounting headwinds to revenue growth. Coming up, Keith Lerner of Truist expecting a volatile year ahead for stocks. That conversation coming up next.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow, just moments away from the start of trading, and you can see a churn beneath the surface as we try to get some sense. S&P futures lower by about 0.1%, really spurred by John Williams coming out, trying to walk back some of what we heard from Jay Powell. A little bit of a lift, though, still in NASDAQ and Russell. Outside of stocks, you can see in the bond market, again, a bit of a reversal on some of those comments. 10-year yields just a bit higher, retracing from some of the earlier gains that earlier losses, I should say, that we saw earlier. Just up marginally, 3.93%. Crude hanging on to gains, and the euro dollar still lower, weaker after being stronger for most of this week. A bit of dollar strength as people really assess whether the euro region can avoid cutting rates as soon as March. One stock to watch at the open is Costco, the company topping earnings estimates and announcing a special $15 dividend. Bloomberg's Abigail Doolittle has more. Abby.
And on this, Lisa, we do have this stock up 2.7%, the best day since May of this year. So shareholders are very happy about those results. That profit beat, revenues basically in line. Now, it was against tough comps, still coming out solid. Traffic was the real contributor here, offsetting some declining ticket transaction sizes. They're also talking about seeing moderating prices, about flat to up 1% versus what had been up 1 to 2%. They are saying that their strong value added, high renewal rates, and club expansion plans make Costco well positioned. And it's interesting, Lisa, because on the year, Costco is really the best in class for these big box retailers. If you take a look at Target, it's down a little bit on the year. BJ's Wholesale Club basically flat. Walmart up about 7%. We also have analysts excited. Lots of price targets raised on this street, and Costco right now up 2.5%.
Abigail, thank you so much. It looks like it's the most since May 26, as you were mentioning. Turning now to the automakers, GM cutting more than 1,300 hourly jobs across 2 plants in Michigan. Bloomberg's Ed Ludlow joining us now from San Francisco with more. Ed.
Good morning, Lisa. GM up 0.2%, 1,300 hourly jobs, which is interesting in the context of it just being a month since they struck that agreement for a new labor contract and it was ratified by its unionized workforce. The majority of the 1,300 are at the Lake Orion plant, about 945 jobs. That's significant because it was where they've been building the Chevy Bolt, which, as you know, will be discontinued, and where they had delayed plans or pushed back plans to build electric pickup trucks there. That will now take place starting in 2025. What I find astonishing, GM now softer 0.1%, but on the week, we're set for a pretty significantly weekly gain. This will be GM's 6th successive weekly gain, its longest run of weekly gains, going back to December 2014. So job cuts, all the chaos with Cruise, its autonomous driving unit, and all the doubt that we have about the real demand for electric vehicles doesn't seem to be deterring investors who have been pushing the stock higher for 6 straight weeks.
Ed Ludlow, thank you so much. Getting back to earnings season, Darden shares under pressure after cutting its annual revenue forecast. Alex Semenova has more on breadsticks. Alex.
Hey, Lisa, good morning. So Darden Restaurants out with a mixed earnings report this morning. That is the owner of Olive Garden and Longhorn Steakhouse. It reported revenue that fell short of Wall Street estimates while also lowering its guidance heading into the busy holiday period. You can see shares moving down more than 4% into the open this morning. Sales did climb, however, 9.7% from the same period a year ago. It attributed that to an advance in same-store sales that removes locations open for less than 12 months. It also attributed that to the inclusion of Ruth's Chris Steakhouse. It acquired that chain back in June for $715 million. Same restaurant sales were up 4.1% at Olive Garden and up 4.9% at Longhorn Steakhouse. So that's giving the results a bit of a boost. Fine dining sales, however, fell 1.7% for the period. So you can see consumers still opting for cheaper dining options. Analysts didn't like that guidance. RBC asked whether this is merely a conservative outlook or if it speaks to a softening trend in recent traffic. And Citi said the lack of an increase in sales guidance points to a choppier industry that could pause upward momentum in the stock. Shares have been up rather 20% this year. Lisa.
Alex, thank you so much. Turning now to the home builders, Lennar shares under pressure due to slightly weaker gross margins on home sales. Katie Greifeld has more. Katie.
And shares of the home builder are following this morning after that report. And I will say there was a lot of good news in this report, Lisa. Let's quickly go through it. In the fourth quarter, Lennar beat on EPS, revenue, and net new orders. And looking ahead, its forecast for first quarter and 2024 deliveries came in above analyst expectations. But if there was something to pick at, it comes on the gross margin numbers. In the fourth quarter, gross margin on home sales was about 24.2%. That is a hair light. And in the first quarter, Lennar sees gross margin on home sales between 21 to 21.3%. That is below estimates of 22.9%, and that is what is dragging the stock lower this morning. But the bar was really, really high for this name. It hit a record high going into this report, and since just the start of November, shares are up almost 40%, so a little bit of disappointment today.
And up 68% since the beginning of the year, Katie. Good perspective. Truist's Keith Lerner looking ahead to next year, writing, entering 2024, we have had a very sharp rally and sentiment is much more bullish. Thus, the bar for positive surprises is much higher, which is exactly what we saw with Lennar. Keith, I'm so glad to say, is joining us now. Given that feeling that you have that the bar is so much higher, do you think that we're set up for some softness heading into January, especially given the rally we've seen over the past few weeks?
Yeah, well, great to be with you again, as always, Lisa, especially on this Friday. First of all, we've enjoyed this rally. We put a note at the end of October saying it was a buying opportunity, and we thought small caps and the equal weight index would outperform. So we've seen this big move up, stronger than we even thought at that time, but it just shows how oversold the market was, and we've seen this pivot. And I do think, more directly to your question, that it likely sets up for at least choppier waters, maybe as we get a little bit deeper into the first quarter. That would be consistent with what tends to happen during an election year, where the first part is somewhat choppier. And then also, if we just think about, where we were a year ago coming into the year, last December, we had about a 7 or 8% correction during December. We had bearish sentiment above 50% on the AAII. And this year we have, a ramp up, right? 15% up off the lows. Small caps are up 20%. Home builders up over 40%. You just talked about Lennar, but 40% over the last 6 weeks or so. So I do think that bar is somewhat higher heading into next year. I will say one thing, though, as you look back over, say, the next 6 months, one thing that's encouraging is that we were able to get so overboard. We did a study, which I can talk about this morning, that shows when you get this overboard, it suggests a little bit of a pause. But when you look at 6 months forward, the positive hit ratio is actually pretty good.
That's what Neil Dutta actually pointed to this morning of Renaissance Macro. He was saying, actually, when things are overbought, that's usually a good time to buy, since it tends to melt up further from there. At that point, though, Keith, are you still aggressively neutral?
No, I'm glad you remember that. So we've been more tactical, and I would say after this move up, I'm back into that same spot where we've been. And I think that's the story for next year, too, that there will be these tactical opportunities where the market, overdoes things when we're talking about inflation, soft landing or not, whether the Fed actually pivots and when they pivot. So I think investors just should be prepared that it's not going to be a year to be on autopilot. We're going to have tactical opportunities just like we had this year as well. And not only do we have the election here in the U.S. next year, we have 40 elections around the globe. And of course, there's going to be things that come up that none of us know, which happens every year as well.
Well, Keith, just to talk about the tactical play, because a lot of people are talking like this, saying it's going to be volatile, just the way it was this year, with similar overshoots. So how do you know we've overshot? What are you leaning back against today, for example?
Yeah, well, so maybe one of the most obvious examples was back at the end of October when we put out the note about an opportunity. We look at sentiment figures, and we also look at the broadness of the decline back at the end of October. The broad-based market was down 10%, small caps were down 17%, real estate was down over 20%, and some of the sentiment metrics that we looked at was the lowest we've seen since the fall of last year during the depths of the decline. So we lean on that, and at the same time, when we look at the sentiment side, we say, what are the fundamentals saying? So one of the things that gave us conviction to have that call was that the forward earning estimates for the overall market was moving forward. So what would we be looking at is same thing. Are the earning estimates going up, and are we having more of an emotional move down where we think things are solid beneath the surface? Are the economic trends still stable? From the economic standpoint, I think things to really keep a close eye on into this new year continues to be the initial jobless claims, and then also credit. Credit has been a good tell that as rates have pulled back down more recently, credit spreads have come in. So that tells you that was more of a disinflationary trend, less concerns about the economy.
Yeah, which really raises this question whether bonds and stocks can continue to rally together. And that's been sort of the trend for a while. It's gone so on steroids recently over the past few weeks. Can it continue?
Well, it's interesting. Just yesterday, after this move down, we were overweight duration. We went neutral duration, at least from a short-term perspective, moving that as rates have moved down to 5 to 390. We still think bonds ultimately go low over the next year. We just think that's moved pretty quickly. And to your point, one of the big fuel for the market has been this move down in yields. So that's another reason I think to expect as we move into the new year, probably a little bit of a digestion period before the market tries to make another leg up. And to your point, that study that we did, we looked back since 1980 when we seen the RSI, which is the relative strength index, right? Commonly, you can look on your Bloomberg, you'll see it there. It went above 79. And we went back the last 23 times it's happened since 1980. 21 out of 23 times, 6 months later, you were higher. But on the shorter term, you were somewhat more mixed. And that's typical of these kind of overstretched index. And that lines up with the 10-year also now probably more likely to consolidate and be less energy or fuel for this market than it has been over the last 6 weeks.
I guess that this goes to the heart of the question that a lot of people have been asking and trying to answer, which is 60-40 dead? Is it coming back? Can it be reliable? How do you sort of frame your investments with the idea of bonds as a hedge to risk?
Yeah, well, listen, I think the 60-40 is in a much better place than it's been for the last several years, simply because the interest rates are still higher than they have been. The reason why the 60-40 had a problem, it was that there was no coupon, so you didn't have that cushion, at least now, and maybe it's not as good as it was, a month ago, but you're still at, close to 4% on the 10-year. So I still think that will be a positive, altogether, the 60-40 is still works. And don't forget, the expense ratio to get access to these things is a lot lower than it's been historically as well. But on top of that, I do think there will be times where we'll have to be more tactical as far as where we invest within fixed income, where we invest within equities, and that's where we can help smooth the ride out. And also, maybe outside of this, alternatives and things of that nature.
Meanwhile, we are seeing a bit of a reversal, but really no drama this morning after New York Fed President John Williams in an interview said, we aren't really talking about rate cuts, just sort of the way that Jay Powell was talking about. We aren't really talking about rate cuts. He's saying also it's, quote, premature to be thinking about cutting interest rates in March. Keith, do you buy it?
We've been thinking that they were going to raise more in the middle of the year. And another thesis was, to be candid, I'm rethinking a little bit, is we've been thinking the Fed would have scar tissue from this inflation that got out of hand over the last year, and their reaction function would be somewhat slower. Powell kind of, talked against that. So I think the rate cuts are likely coming. We're still in the camp that it's likely maybe later than March, but I think the more important message for the market is that they are likely coming, and that the Fed has said something important, is that they're more focused on the inflation coming down. They're more focused now on keeping this economy out of recession. So I think they are coming, but again, maybe March may be a little bit premature in our view.
Keith Lerner, you're sticking with us. Coming up, Secretary Yellen gearing up for a trip to China.
America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country.
China's economic recovery losing momentum, adding pressure for another round of stimulus. That conversation up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
World of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
I'm a conservative, but I'm not in a bad mood about it. Fellow governors.
Bad mood about being conservative? Is that because you feel like populism has taken control of your party?
And Joe Matthew.
What is it about race that bothers you about the new chairman of the Joint Chiefs?
Our military is becoming so political that we're going to go south when it comes to readiness.
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that
you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. Context changes everything.
Welcome back. There are some breaking news crossing the terminal having to do with economic data. Let's get the details from Abigail Doolittle. Abby.
Indeed, Lisa, we do have the U.S. PMIs crossing the terminal right now. The preliminary numbers for the month of December basically mixed to in line relative to the overall composite, though slightly hotter than expected. The survey had expected 50.5. It came in at 51. That's above November at 50.7. Relative to the breakdown for manufacturing coming in at 48.2. A little bit below the estimates and a little bit below November, so some cooling for these smaller to medium-sized companies for the month of December so far. Relative to services, though, up a little bit, up 51 at 51.3. Overall, above 50. So the economy per these U.S. PMIs, the preliminary for December, Lisa, showing a little bit of expansion for the economy.
Abby, thank you so much. Treasury Secretary Janet Yellen planning to visit China again in 2024. On the agenda, discussing what she labeled difficult areas of concern, including outbound investment, sanctions, and national security. This as China's economy continues to slacken. November data trending downward year over year. The central bank injecting a record amount of cash into the economy in an attempt to offer some relief. For more, we have Kaylee Lyons in Washington. Kaylee.
Well, Lisa, if you look at this data, the comparison really isn't fair because, yes, you did see an expansion in terms of industrial output and retail sales, but what we're comparing to is a year ago when the economy was being severely hampered by COVID lockdown. So analysts say, actually, when you are comparing to more typical periods, yes, these numbers were down last month. There also is, of course, the issue of China's property sector. Property development investment has fallen 9.4% this year, according to government figures, which is why you are seeing more calls here for stimulus. Yes, the PBOC overnight did have that record $112 billion cash injection in terms of its one-year loans commercially, but it just underscores that more may need to be done here and that China is really feeling economic pressure at home as it also faces economic pressures coming from U.S. policy. And that really is what Treasury Secretary Janet Yellen was talking about last night. Yes, she said she's going to try to continue normalizing these relationships, areas of communication and cooperation, which is why she is planning on making another trip to Beijing next year after she did so earlier this summer, as we have seen a number of administration officials do, and of course the meeting with President Xi Jinping and President Biden in person in San Francisco just last month. But Yellen also was taking some shots at China here, talking about national security issues, the idea that there is not a level playing field for U.S. businesses because of what she deems unfair economic practices. So there are still areas of confrontation. She said that the U.S. still intends to continue pursuing export controls as well as restrictions on investment into China. At the same time, though, they do want to have collaboration in some areas, and she reiterated the messaging we hear consistently from this administration, which is that the U.S. is trying to protect national security interests and compete with China in a healthy way, but is not, Lisa, seeking to decouple.
Kaylee, thank you so much. And a lot of this is being fueled by the business community that is trying to understand what the groundwork is for them to participate in the Chinese economy, the second biggest in the world. Still with us is Keith Lerner. And Keith, I'd love to get your view on how much you can lean into this idea that there could finally be a recovery in China, the story that did not materialize in 2023, but could become one in 2024.
Well, I think that could be an upside surprise, but I will say color me skeptical. We have zero exposure in emerging markets in our portfolios, and part of that reason is because China represents over about 30% of the index, and we've had that position since early last year. And I think what you have to be careful about is, for the first time really in the last 20 or 30 years, we're seeing foreign direct investment leave China. And I think every business owner that is doing business there just has to say, do I want to have all my eggs in one place? And you're going to see more diversification out of China. The other thing that's interesting more from a market perspective, we talk about tech being the big catalyst this year for the main headline markets. Well, the Chinese tech companies are closer to the lows than the highs, and that's because of the crackdowns we saw a few years ago. Profitability is not nearly the same as well. So maybe, some of that stimulus helps stabilize the economy as well, and maybe that's a bit of an upside surprise. But overall, from an investment standpoint, we are skeptical. And if we thought that was going to be a lift, we might be more interested in playing, part of Europe as a trade partner as opposed to China directly.
That's where I was going to go. How much does this really affect your call on Europe?
It doesn't. And the other thing I will say, when we think about if this, let's say the global economy is stronger and the U.S. economy is stronger, I think the other thing you can think about is, do I want to play Europe, or is a better place to be is U.S. small caps or the equal weighted index? Really, that's what we would say. It would be the latter, where you would want to be in you say Europe, is that you're really making a call on the currency. We think the dollar is more in a choppy range that continues. If you were more bullish about the euro, then maybe that's a better place to be. But we think even now you're seeing during the cyclical rebound, the equal weight small cap cyclical U.S. is outperforming Europe, and we would stick there for that exposure.
What's the thinking behind staying in the U.S. and trying to gain exposure to these other stories, but solely through U.S. investments? Is it just that it's a more reliable legal and other an economic framework than, say, a place like China? Or is it because just simply the number of scenarios that benefit the U.S. and all of the assets therein are so much more plentiful than the others?
I just think it's a high quality universe in general, and I don't want to say there's not opportunities overseas. There certainly are. There's more companies overseas than there are in the U.S. So I want to be clear on that. We do have international investments. We're in developed international. We're just much below our kind of benchmark weightings. And again, I think we share some skepticism as far as investing directly in China because of the profitability side. We'll change our view if the profit trends overseas improves. And a lot of times when people invest, you're not investing in the economies of these countries. You're investors in companies, and the sector composition makes a big difference. If you look at Europe relative to the U.S., you have a lot more Europe. You have European banks being much bigger allocation in some of those indices, and technology, much less. So if we turn more negative on tech, or investors are more negative on tech, more likely some of these other areas in the developed world will do well. I mean, Japan's acting better as well. So again, there's opportunity there, but I just think there's a way to play that cyclical exposure through higher quality companies within the U.S. directly, and that's how we're playing it today. But again, we're trying to keep an open mind as we move over the next year.
Keith Lerner, thank you so much. Have a wonderful holiday. If I don't speak with you before then, coming up, the market-moving events that you need to be watching. That's next in our trading diary. What you can see is a bit of softness on the S&P, strength on the NASDAQ, strength, when you could see, is still in a number of different asset classes. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg The Open. I'm Lisa Abramo. It's time now for the trading diary. But before we get there, I just want to say the NASDAQ really climbing in that haven bid. Coming up, a Bank of Japan rate decision on Tuesday, Micron earnings after the closing bell on Wednesday. Thursday, we'll get U.S. GDP and another round of jobless claims, followed by quarterly results from Nike. And finally, U.S. bond markets closing early for the holidays on Friday, as everybody does go away for the holidays and to start the new year. Right now, people are churning, trying to digest what John Williams said, trying to push back, saying that the market was overpricing the chance of a March rate cut, not really denting the toothpaste kind of out of the tube. This was Countdown to the Open. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction. We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
And good morning. Welcome to Bloomberg Markets. Paul and Matt are enjoying a well-deserved break and filling those big shoes today. I'm John Tucker, along with Bailey Lipschultz. Hi, Bales. Mixed right now, these markets, but this recent rally, you know what? It has a name. Forget pivot. Let's call it Ricardo. Go, Ricardo, go. There he is. The Longhorn broke free, headed down the tracks at Newark, New Jersey, Penn Station yesterday. Finally rounded up, and now instead of a flank steak, Ricardo is going to live out his life at a New Jersey resort, apparently. Let's start things off this morning with a Bloomberg business flash and a closer look. He likes his steaks medium rare. Nathan Hager, good morning, Nate.
That's one way to rein in the bull. Thank you, John. Well, you know, there had been all this exuberance since Wednesday, the talk of a Fed pivot. Well, so much for that. With a bucket of cold water this morning from New York Fed President John Williams saying they're not really talking about rate cuts right now. So we see that mixed market this morning. But Morgan Stanley's global head of corporate credit research, Andrew Sheets, says he does see room for the market to pencil in easing after all.
Inflation is finally coming down, which gives these central banks a lot more flexibility to moderate policy as that happens. So again, you know, you've seen central banks react to that a little bit differently. The Fed sounding a little bit more dovish, the ECB sounding a little bit more hawkish. But I think the core message as you go into next year is these are central banks that are done hiking, they're going to be cutting, and the path is going to be easing going forward.
You can hear more of my conversation with Andrew Sheets of Morgan Stanley on this morning's Bloomberg Daybreak U.S. Edition podcast. But after that, little bit of hawkishness this morning from New York Fed President John Williams. We do see mixed markets, and we check them for you all day long here on Bloomberg. Right now, the S&P 500 is down 7 points, 0.2% lower. 4712 is the S&P level. The Dow Jones Industrial Average down 88 points, or about 0.25%. 37,157 for the Dow. And the NASDAQ still holding on to a gain, 43 points higher, or 0.3%. 14,806 is the level for the NASDAQ composite. The 10-year Treasury is up 230 seconds for a yield of 3.91%. NYMEX crude's down 0.5% right now, or 37 cents at $71.21 per barrel. COMEX gold is up about 0.2%, or $3.40 at $2,048.10 per ounce. And the euro a little bit weaker against the dollar at 1.0917. The yen is at 141.76. That's a Bloomberg Business Flash, and Bloomberg Markets is on now with John Tucker and Bailey Lipschultz.
Nate, thanks a lot. Appreciate it. Let's take a look under the hood this morning. And our markets reporter, Abigail Doolittle, is with us. What are you looking at?
I am watching the mixed markets this morning. I'm really kind of interested in this Fed talk that we've had. It's always interesting to me when you have these officials, these Fed governors talking against each other. So, of course, Fed
they give us the punch bowl. They take the punch bowl away, and
very experimental. I think that you know, this is not new. They've been doing it for as long as I've been watching the Fed. But they like to see how the market's going to react. So what they learned is Jay Powell, Fed Chair Jay Powell, at the beginning of the month can say higher for longer. Then about 2 weeks later, he can say, oops, no, I'm backtracking. We're going to cut next year. And then 2 days later, Fed Governor Williams in particular can come out and say that that they're not really thinking about cutting right now and that March is premature. On that, not too much of a reaction. We have the S&P 500 down about 0.1%. We have the Dow down about 0.3%. The Russell 2000 small caps, which have really been on fire this week, basically, reaching the recent highs over the last year within just a few days. It's retreating about 0.2%. On the other hand, you have the NASDAQ 100 up 0.5%, yields sort of just about flat. So they're learning that if they want to take away the punch bowl, they're going to have to be much more forceful.
Well, Abigail, that was going to be my next question. When I look under using the IMAP function on the S&P 500, tech communication services are rallying, but we have utilities, healthcare, and energy down.
Well, and I think that those are of course, the dividend-rich sectors. So earlier, moments ago, you had yields a little bit higher than where they are now. You had the whole yield curve, at least I looked at one point up, a couple basis points. Now you have the 2-year yield up 2 basis points, some of the other yields coming in just a little bit. So when yields go higher, those dividends look less attractive. It's interesting with tech and communication services higher up top, outperforming and discretionary now basically flat. I'm reminded of an idea that I don't necessarily agree with, but the idea that tech is the safety trade. Mm-hmm. So folks going with the biggest, safest. It's interesting. Microsoft had been down on Fed Day, or basically flat to down. Yesterday it was down sharply. You've had some of these big tech names really pulling back in anticipation of some sort of rotation into broader sector participation and into value. But now that we have like a little bit of a tug of war, within the Fed, a public tug of war within the Fed, you see people flocking back to the safety of Microsoft and Amazon and NVIDIA and Meta.
Can we put to rest the concerns over the breadth of the market? I think it was Gina Martin-Adams, Bloomberg Intelligence, who pointed out there's something like 65% of stocks are above their 200-day moving average.
Yes, and 90% are above the 50-day average, which is telling me, so when you put those two together, what's interesting, I can't speak to the 200-day moving average, but 90% of S&P 500 members are above the 50-day moving average. That had been true in July, too. We're now at a higher peak. If that participation turns down, it would actually, I think, be a bearish divergence because you would have stocks at a higher level, but with less participation. But, I mean, it's very solid. The fact that you have 60% above the 200-day moving average, that tells you the long-term buyers are very interested. And the fact that you have 90% in the short-term buyers interested, that could point to some kind of volatility ahead. And speaking of volatility, it is triple witching. Sounds kind of ominous, I guess, or I guess quadruple witching used to sound a little bit more ominous, but either way, there could be some volatility. There will certainly be some more volume. We also have the reconstitution of both the S&P 500 and the NASDAQ 100.
Who's going in? Who's coming out?
Bear with me. I do have notes on this because I'm going to be reporting on it soon on Bloomberg Television.
You got DoorDash and Splunk being added, MongoDB, just off memory, Zoom Videos getting the boot, I want to say, along with
Lucid getting the boot.
Yeah.
JD.com, CDW going in. And I think that
what's the decision that goes behind it? Some sort of market cap or what?
It's partly market cap, but it's also earnings and fundamentals, like on actual performance metrics, right?
I'm not sure entirely. I'm more familiar with the FTSE, which I think that is strictly.
But that should give those stocks, if you're going into the index, you're going to get a boost because as a fund manager, you have to buy it.
They have to wait, and it's interesting to see. So Align Technologies, they basically have gone out of business recently, which was sort of.
So that was Smile Direct Club.
Excuse me.
Different
I'm so glad that
they
you're
make
saying
Invisalign,
that.
Different companies.
Do-it-yourself dentist.
Thank you so much for saying that. I'm so glad that you. Yes, same space. So Align's going out. eBay, JD.com, Lucid, and Zoom. Zoom at least, certainly a pandemic darling. Lucid no longer in Tesla standing. JD.com having a tough year. Enphase Energy had been a darling, now out. So it is kind of interesting to see that. But it's definitely, this could be considered, today might be the last big liquidity event of the year. Tepid volumes probably for the next 2 weeks outside of maybe the last day of trading.
Because the thing that's always interesting to me
Thank you so much for that correction.
No, definitely.
I just took the Bible class the other day, and those are the big.
Is the inclusion, though, when you look at the market now, especially with so much cash being allocated to ETFs, whether that's just retail traders, but also fund managers, we're seeing a lot of buying of the Qs and TQQs and getting the leverage. Just getting included opens you up to so much more forced buying.
100%, because, yes, to your point, I'm reading right here, Standard & Poor's estimates that nearly $13 trillion is directly or indirectly indexed to the S&P 500. And for just the S&P 500 ETFs alone, $1.2 trillion. QQQ is the 5th largest with $220 billion under management. So, yeah, a lot of money is going to be changing hands today, most likely, and perhaps early next week as well.
Especially we head into the holiday season. We've got 2 weeks left of the year, which is.
I'm off next week, so,
So you have 1 week left.
Yeah.
JT, are you celebrating anything, though, next week?
Well, I'm going skiing next week.
Where?
I am heading to Vermont, and I have the cameras that I look at, the web cameras. Killington.
I love Killington.
Only because
5 mountains.
5 mountains, and they make their own snow. So if
Can't go wrong if it's Mother Nature's not cooperating.
I think JT's celebrating something.
Yeah, that's
right.
right.
I think you're bearing the lead there,
Yeah.
John Tucker.
What are you
You know,
celebrating?
believe it or not, it was 30 years ago today. I walked, not through this building, but the 499 Park Avenue. Walked in and they put me to work.
That's wonderful.
I was at the time I was at CBS, and CBS didn't want me to go. They said, "Can you still fill in because we don't have anybody to work the Christmas shift?" So to be a nice guy, I didn't want to burn any bridges.
Look, if anybody's on the YouTube feed, look at these
That was a picture of me 30 years ago.
Can you play that again?
Walking into Bloomberg.
Oh no, that was
Hi, Mike.
high schooler.
I'm John Tucker.
Wow, that's great.
That's actually-
I can actually see I see it.
I'm the one of them. That's actually my. No, you guys asked me for the picture from 30 years ago. The best I could come up with was my 8th grade graduation. It was like 30 years. Right after 8th grade, I went right to work at Bloomberg. So.
I think we also have some treats for you
Do we
somewhere
really?
back
Yeah.
there. We talked to the
exciting.
producers. Elizabeth back there, gracious enough to pick up, I believe, some of your favorite treats there.
What are those favorite treats?
Are we gonna
Out of
surprise
curiosity.
them? Bring it out, or
Pressure's
so
on.
what's your favorite
what's your
type
favorite
of
treat?
Oh, carrot cake.
That's exactly what it is.
Yeah. Oh my
That is
God.
great.
Yeah, 30 years. Can you believe that? It only seems like 50.
How does it feel? I mean, you've covered a wide variety of
Well,
many global events.
The
over
question,
the last 2 decades.
when I got here, the Dow was nowhere near 10,000, and I remember being told, it's like, when it hits 10,000, it's just another number. We're not going to make a big deal of it. I'm
Now
like,
37,000 on the Dow.
Unbelievable.
if only I'd actually invested.
Oh, man.
So who knows?
How did you get into radio? Because it feels like when people hear your
It
voice,
was,
you were born
I
for
will
this.
credit one of my classmates in high school who said, you know what, you have a really good voice. You should do that. And then I went to, in college, I was actually a science major thinking about replacing my dad in his practice. He was a dentist. And that didn't really pan out. And then I saw an ad for, like, we're looking for people for the college radio station. That was WFDU, Fairleigh Dickinson's radio station. 89.1, the voice
That's a
of
known
Fairleigh.
radio station.
That's actually a
That'd
real
be
radio
one of the
station.
big college
Well, we
ones.
share the frequency
Like music.
with NYU. So, but
Oh,
I
so
was the news director and also the jazz DJ in the afternoon. And you know what I know about jazz? Not a damn thing.
Well, hopefully you learned something.
You know what? And then you pivoted over here. It's pretty amazing.
Oh, boy, yeah. Speaking of pivots, thank you very much. That was very sweet of you. I appreciate it. Let's pivot to the markets. The minister, Menton, with the look at the market. What are you looking at today?
Well,
Another
big
Texas
thing.
Longhorn. We started the show with the Texas Longhorn that got loose on the tracks.
She's not a Longhorn.
Yeah,
she's an Aggie.
thanks
Oh,
for
an
rubbing that in.
Aggie.
I go to that other school that's a
I
rival.
know.
But you know what?
You're
My
from Texas,
My
same
sister and
thing.
my mom went to that school in Austin, that other school that, has Longhorns. But I went to Texas A&M, John Tucker. But I like that segue, though. Still talking about the
Well, we
South.
try.
People are confused why he's calling me the Minister Menson. It's because I'm ordained and was able to marry a couple of my friends here. But in other news, though, triple witching today.
Preside over. You didn't actually marry them. You presided over
Options
the wedding.
tied to single stocks, ETFs, and indexes set to expire. So this is actually options linked to more than 8% of the S&P 500 market cap set to expire today. So roughly about $5.4 trillion. We got a story on the terminal that walks through this. Also, as Bailey knows, Elena Papina, one of our star reporters here on the equities team, covers options very closely for our equities team. So I encourage anybody to read her work. But looking at that, that's going to be a key movement, especially as you head into the closing bell. There's also the rebalance we had reported on in the last few weeks, how you're going to see some different name changes going into the S&P 500. When you are thinking about companies like DoorDash, and then Uber, looking at that, especially when the NASDAQ 100, a lot of those changes are going to take into effect before the open of trading on Monday. So those are some things to keep in mind if there's some volatility heading into the closing bell, some factors happening with that. So big when it comes to the options market here, but the S&P 500 on set to gain for a 7th straight week. We do have another story on the terminal, though, when it comes to when you're talking about these sort of pivots here, JT, and you're talking about the Federal Reserve and the central bank decision earlier this week. So you have Federal Reserve Bank president from the New York, John Williams. So he was speaking earlier today, kind of pushing back against the thought that they're talking aggressively about rate cuts soon. But he has said recently in the past few weeks too, pushed back against that and really said that they're already obviously at when you are looking at the terminal rate, sort of the potential peak rates here. So really people are starting to question right now, not just rates, but what's going on in the background with its balance sheet. So that's another key topic as far as what that means for recent funding, sort of market squeeze, and what that could mean for basically liquidity concerns. And a lot of people talk about that because back in the fall of 2008, not only a trade war going on, but that was when the Fed was paring back their balance sheet. And when you talked about different liquidity issues that year, that it was a volatile fourth quarter, and particularly that December at the end of 2018, if anybody remembers, that's when markets had bottomed that Christmas Eve. So it wasn't a quiet Christmas week that year, but that's what people kind of focusing on, what's happening with sort of the quantitative tightening and when it goes with the balance sheet. So not just what's happening when it comes to those interest rates, but people keeping a close eye on that ahead of, but we still have a while. So the next Fed decision is actually January 31st. Next CPI report will be on January 11th. So got all those keeping in mind over the next month or so.
Elizabeth was able to make a 30-year chart. What's this, of the Dow?
Yeah, Dow
I love this.
From when JT started.
Look at this. Oh, so the S&P 500 is up 922% roughly since John Tucker started at Bloomberg
call that
News.
The Tucker Rally.
You should have been getting
Tucker
paid
Rally
in S&P like linked ETFs. I don't know if were ETFs a thing 30 years ago.
I don't think. No, I don't think
Okay.
that's a relatively recent invention.
Right. It was so a little bit different though. But looking at the Dow though, now 37,000 on the Dow Jones Industrial Average.
Yeah, I was there for 10,000, for 20,000, and for 30,000.
And you'll be here for 40,000.
Yes.
Well, if it happens before year end, no, I probably won't. So who knows?
Vacation
I missed that.
Always a pleasure with you gentlemen on this Friday. Is Paul at the Sweeney compound, I'm assuming?
I have no idea.
Paul is
and
listening
Tom
through the Sweeney compound. Matt's in his car listening on Apple CarPlay is what I normally get told.
Oh, yes.
That I suspect is the case. Anyway, S&P 500 right now, not a lot of movement, down 2 points at 47.16. The Dow 80 points lower after another record close yesterday, 37,167 on the index. And the NASDAQ 100 right now, that is higher, up 93 points, a rise of 0.6%. Yeah, 30 years. Let's do it another 30 years coming up. You are listening and watching Bloomberg. And right now, let's get some company news. Lisa Mateo is with us. Hi, Lisa.
Hey, John. 30 years. Deserve that vacation next week. Good morning. Costco has announced a special $15 dividend after continuing a string of solid results. Bloomberg's Abigail Doolittle says traffic was the biggest contributor.
They're also talking about seeing moderating prices, about flat to up 1% versus what had been up 1 to 2%. They are saying that their strong value added, high renewal rates, and club expansion plans make Costco well positioned. On the year, Costco is really the best in class for these big box retailers. Target, it's down a little bit on the year. BJ's Wholesale Club basically flat. Walmart up about 7%.
Now, as far as membership fees, its CFO said it's a matter of when, not if. Costco right now up about 3.5%. And shares of Darden are lower. The owner of Olive Garden and Longhorn Steakhouse reported revenue that fell short of estimates and lowered its guidance. Bloomberg's Alex Semenova says there was some good news.
Sales did climb, however, 9.7% from the same period a year ago. It attributed that to an advance in same-store sales that removes locations open for less than 12 months. It also attributed that to the inclusion of Ruth's Chris Steakhouse. Same restaurant sales were up 4.1% at Olive Garden and up 4.9% at Longhorn Steakhouse.
Now, the problem is that fine dining sales fell 1.7%, and shares are down more than 1%.
Connection lost.
And talk of interest rate cuts could be welcome news for the secondhand luxury watch market. According to Bloomberg's Sundial Watch Index, used prices for brands like Rolex and Patek Philippe fell when the Fed raised rates. I'm Lisa.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Just about 10:22 on Wall Street. I'm Nathan Hager, and we check the markets all day long here on Bloomberg. Stocks are trading a little bit mixed after a bit of hawkish commentary this morning from New York Fed President John Williams, saying the central bank is not yet talking about rate cuts just yet. Right now, the S&P is little changed, down a point. The Dow is down 82 points, a drop of 0.2%. The Nasdaq still holding on to a 0.5% gain. It is up 68 points. 10-year Treasury is up 6/30 seconds now. Yields down to 3.89%. NYMEX crude is down 1.2%, down 89 cents, $70.69 for a barrel of West Texas Intermediate. COMEX gold is up 0.4% at $2,052.50 per ounce. The euro, 1.0919 against the dollar. The yen is at 141.58. Might need to watch for some geopolitical risk for global shipping. Container giant AP Moller Maersk has told its ships headed for the Red Sea to halt voyages following an attack on one of its vessels. Houthi militants have been going after merchant shipping in the Red Sea, particularly vessels they say are connected to Israel in response to the war in Gaza. That's a Bloomberg Business Flash. Bloomberg Markets continues now with anniversary celebrant John Tucker.
Yay.
And Lipschultz.
Oh, I can't believe
Happy
you missed it.
anniversary, John.
Yeah, thank you very much. I wish you were here.
Yeah.
Very nice carrot cake cupcakes, by the way.
Cupcakes at 10:23 a.m.
Don't do that to me.
It's how we roll here at Bloomberg.
It is late enough for that in the day. I'd be all about a cake right about now.
Yeah. Bit of celebrating here in the Bloomberg Interactive Brokers studio for the man JT's 30th Bloomberg anniversary. A lot going on across Wall Street. One of the things that's going on in particular to Citigroup, the company is shutting down its muni business that was once the envy of rivals. And right now, to discuss that, we are going to be talking with Bloomberg finance team leader Sally Bakewell, who has been leading the coverage all over everything developing with Citi. Sally, just kind of give us a 30,000-foot look of what this means for Citigroup as CEO Jane Fraser still continues to reshape the company and its operations.
Right, well, it means a lot for both Citigroup and it means a lot for the muni market there, because Citi had really dominated that 4 trillion space of underwriting local and state debt for most of the past decade. In fact, it ranked among the 2 biggest of municipal bond underwriters by volume. It's been on deals like the rebuilding of the World Trade Center, on rebuilding the port authorities of New York and New Jersey. But as Citi has struggled in recent years through a number of issues, and including its sort of inability to deliver returns and meet financial goals. And so Jane Fraser, who has been at the helm for a number of years, her broader aim is to make Citi a bank that, serves large multinational corporations, but also improves returns, which have been trailing. So I think the Muni business became incompatible with that goal for a number of reasons. I think a big one being that Texas is the biggest state for Muni bond sales, but Citi, owing to firearms policies, got frozen out of a number of big deals there, and that did crimp a lot of its revenue and ability to generate profits. And I think deliberations continued for a number of months over this big decision, and they have, decided that it would be better for Citi, which is undergoing a number of restructurings in other areas, if it was out of this market.
Yeah, the almost impeached, well, I guess he was impeached. It wasn't removed, but the Attorney General there, Ken Paxton, is kind of in charge of that, taking aim at all the big underwriters, all the money center banks that have policies with which he disagrees by freezing them out of that market. The end result was that it's taxpayers who foot the bill because they don't get the best pricing for their munis. Is there anybody around to pick up the slack, or are other banks facing the same situation? Is anybody going to be left?
Well, I think the scrutiny is definitely there on all of the banks, but I think there are banks who are picking up the slack. In fact, a team of from Citi actually defected to Jefferies just in November after news that Citi was weighing pulling out.
They saw the writing on the wall.
I think the writing has been on the wall for a little while. In fact, Citi also shut its Muni prop trading desk not too long ago, that was the desk that used the firm's own cash to trade and invest in the debt, and that has now translated to a complete wind down of the business by the end of the first quarter. But Citi ranked number 7 in terms of Muni bond sale underwriting. Bank of America is first, RBC Capital Markets is second. Then you of course have the likes of JP Morgan, Jefferies, Morgan Stanley, Wells Fargo. So in terms of picking up the slack, there is still very much a market there. I think for Citi it represented at one time, a very significant business, and also the ability of the bank to connect to the country on a broader, sort of deeper level, because it was providing financing for, schools, hospitals, railroad, and so on. And that's an important thing for a bank to do and to be seen to be doing.
And Sally, just for a sense of how crucial munis are, how does munis play into the broader business for these banks in terms of generating fees? Just looking at the league table that you guys have in the chart, Bank of America with almost 13% market share at $44 billion of volume. How does that compare to things like IPOs and M&A and actually generating fees for these big banks?
Yeah, I think it's a very substantial part of what any bank that's involved in the market does. I mean, there is a sort of unending spigot of material and deals to work on if you're in the municipal space. So it is definitely a blow for Citi that it was unable to really participate, for example, in the Texas market specifically, it's a very substantial change for the company, which historically had been such a big player in this space going back decades. But Citi is currently going through a big overhaul that it unveiled in September, its biggest overhaul in decades, where it's trying to refocus on 5 core areas. The goal is to make it a leaner, more efficient organization, to remove layers of management, again with that broader aim of improving returns, and that is going to spark a lot of change at the bank, which we've already started to see. We know that there will be job cuts, and there have already been some job cuts, and we can anticipate more next year. But yes, the goal is to make Citi a leaner organization, and I think focusing on more higher revenue, higher margin businesses is the goal, and its Muni business didn't quite align with that anymore.
Well, yeah, Sally, we had the news earlier in the week from our colleagues in London about Citi offering partial early bonuses amid this restructuring. So as you talk about and look at what the path forward looks like, what does 2024 actually look like for Citigroup to rein in their spending and costs and also compete in what still seems to be a very hot war for talent on Wall Street?
Right, and that's a really good point to bring up the bonuses with Citi, because yes, it offered a select number of staff the ability to take a portion of their guaranteed bonus now and leave, rather than risk next year potentially losing their jobs under this restructuring, but being left with no job and no bonus. I think it kind of underscores it's a fairly shocking move, to basically ask people to do this, and I think it underscores the urgency with which Jane Fraser knows she has to start to deliver. The bank had already tried to, or has nearly completed an exit of a number of its global retail markets, and I think it's undertaken other measures to try and right the ship that perhaps weren't deemed to be fully effective, and this latest overhaul is a real attempt to show shareholders that it can set financial targets and meet them, that it can improve returns. And I think for 2024, actually, things possibly are looking fairly solid. We just had Mike Mayo, who's the Wells Fargo very well-known bank analyst. He actually named Citi as his top pick among large cap banks heading into 2024, replacing JP Morgan Chase as his favorite. So he said he's been long and wrong on Citigroup, but he thinks that the restructuring is making them more simple. The management is addressing 2-decade-old problems at the banks, and that it's seeming to get expenses under wraps. So perhaps the subtotal of all of these measures in 2024 is when we do start to see them pay off.
Are we going to see similar moves by other banks dropping their municipal departments?
It's hard to say. I think it depends on the level of scrutiny from Paxton. It will depend on the economic viability of the business under that scrutiny. The other banks don't have the same issues as Citi, though. They don't have to make these dramatic moves to kind of really reshape the organization. So that I think is why Citi was slightly unique in feeling the impact of the situation in Texas and having to weigh up the viability of its business. It is doing this against this backdrop of, as Mike Mayo said, a decades-long sort of problem at the bank of not being able to generate the kind of returns that the other banks were able to do. So I think they will be under scrutiny, but they probably won't feel the need to act in the same way that Citi has.
Citi dropping its storied municipal business. Sally Bakewell with the story for Bloomberg News. Sally, thanks very much. Appreciate your time. You are listening to Bloomberg Markets S&P 500 right now. Only a point higher, 47.20. And the Dow Jones Industrial Average, 48 points lower, and resetting for the NASDAQ 100, the tech-heavy NASDAQ 100, 106 points higher. That's a rise of 0.6%. Right now, let's get some world and national news. Amy Morris in Washington. Hi, Amy.
Hi, John. President Vladimir Zelensky is hailing a victory for Ukraine after European Union leaders agreed overnight to open membership talks with Kyiv. European Council President Charles Michel made a veiled reference to Hungary's opposition as the summit in Brussels broke up overnight.
One leader, Sweden, needs to consult its parliament, which is in line with the usual procedure for this country, and one leader couldn't agree.
Hungary's president also vetoed a major EU aid package for Ukraine. Now, the debate over stalled Ukraine aid and tougher border security means the Senate's going to have to delay its holiday plans. Bloomberg government's Zach Cohen is reporting on this from Washington.
Senate Majority Leader Chuck Schumer announced yesterday that the Senate's going to truncate its 3-week recess that was supposed to bracket both ends of Christmas, and will come back next week and confirm a couple of unrelated nominees, which would give negotiators some time to try to come up with an agreement on border policy that Republicans want attached to any further aid for Ukraine.
Bloomberg government's Zach Cohen in the nation's capital, and with a budget deadline coming up fast in the new year, time is running out again for Congress to avert a government shutdown as House Republicans attempt to renegotiate a months-old financing deal before they leave Washington for the holidays. Money for crucial government programs, including some veterans assistance and food and drug safety services, expires January 19th. Money for the rest of the government runs out shortly after that on February 2nd. The Supreme Court is declining to block Illinois' assault weapons ban. Justice Amy Coney Barrett denied an emergency request for an injunction. The High Court was asked to step in after the Federal Appeals Court in Chicago upheld the law last month. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.